obviously a lot of tools are coming out, and it's going to be with us, I agree, for the next couple of years, and will probably disrupt the same way the internet disrupted and email disrupted what we've been doing for the last 25 years.
Yep.
Yes, and and that's part of obviously the macro landscape, and in some of the positives that I see for that is supportive of risky assets at the moment. Uh, so let's just go back to the 40,000 feet view, because that sets up a little bit the scale. So since the late 90s and mid 90s, really, with NAFTA and what happened back then, and China coming up to become a power, economic power out there, we had a constant decline in interest rates, which helped obviously businesses strive, get cheaper loans to grow their businesses, invest in capex. We had great technology advancements, again, with the rise of the Internet of Things, e-commerce, and all these disruptions. At the same time, we had China coming up, very strong in the global economic system with cheap labor, and so that helped obviously globalization. That helped. We outsource a lot of our labor, overseas, and a lot of the things that were made obviously were made cheap in China, and so that also helped inflation, keep a lid on inflation. We also had a lot of innovation in the financial system, in financial engineering, to offer better solution, to have people have access to capital in an easier way. Obviously for investment, cheaper way of getting access to these with e-trades of the world, and ETFs and whatnot. And all that, happened with a supportive background from, global central banks that, kept loosening monetary policy all the way to, hyper loose monetary policy that we had during COVID that created a little bit of the inflation we've seen. So all of that had made the last 30 years, and so when you look forward, a lot of things are changing. Obviously, globalization is replaced by deglobalization, by reinshoring. A lot of what we've a lot of the developed markets have started bringing capex and investment home to be able to produce things. Obviously, during the COVID and PPE, and when nobody could find goods because trade was down, it raised a lot of questions for both security of trade, security with different vis-a-vis China and other actors, and so that is bringing the opposite trade that happened over the last 30 years. So a deglobalization, a rising cost of capital, obviously, the inflation that we've seen over the last 2 years. The Fed has put severe brakes on rates. They increased rates by 500 basis points, which is one of the fastest moves over the last few years. We had a decrease in workforce. We've seen it and suffering from it, both in services, which is keeping inflation services up right now, because there's such a need with healthcare, with restaurants and airlines, and so that's changing a little bit the productivity and the workforce that we're seeing, versus having China offer all that cheap labor over the years. People are starting to realize that commodities are finite. There also have been an underinvestment of commodities, and that's going to be a theme that you're going to see during this presentation, because it was more like the financiarization of things, and so less impact of real assets, and so underinvestment in mining, underinvestment in a lot of the commodities, and so that inelasticity in supply of commodities is also impacting the inflation that we're seeing. And at the same time, we're at a period where we're back to having very, very high private and public debt in the system, which is usually not supportive of growth because it just there's so much money that goes into payments of interest and refinancing of debt, and the leverage. When rates increase and people have floating rates, we're seeing some of that impact in commercial real estate and some rate sensitive sectors, and that's going to be important for where when we look at sectors of the economy that we care about or not. So all these development are really changing the landscape from what we were used to in the last 30 years to where things are right now and moving forward. And so you know this is a graph of the interest rates over the last 40 years, and as you can see, they were like a steady downtrend, and we broke out of that downtrend last year, and it's possible that these are long-term factors that impact these things higher for the years to come. So that creates a lot of uncertainty in the macro space. There's some geopolitics tensions between Russia, the Middle East, China, and we'll see it with people are talking about de-dollarization. That's a theme as well that you might need to keep in mind for the next couple of years. I don't think any currency is gonna disrupt the dollar as the reserve currency of the world. It requires a lot of factors for it to go, and even China and the yuan, which you're seeing headlines that a lot of Russia and the Middle East are paying now in yuan. So it's true. It means that people are gonna use less dollars in their exchanges, but China doesn't have the rule of law, that it doesn't have the liquidity and the depth of the markets that the US has. And so the US is not going to be dethroned as the reserve currency, but there's definitely it's important for us because we used we exported that, and we international central banks have helped us buy our dollars and also buy our debt, and that matters, right? Because if we don't have, as we get more and more debt, if we don't have as many buyers, then that's problematic. That means rates go higher. That means more difficulty for financing things for small businesses, for all kinds of things. We are seeing strong investments from governments that are replacing what maybe the private economy can do. Infrastructure policies, industrial, green. So that's probably supportive of onshoring, supportive of some sector of the economy, and commercial some part of the commercial real estate, some part of the economy that are seeing investment from the government. Around like 400 billion to 2 trillion is not a small amount, and so that can kind of compensate for the lack of investment from the private sector. We're seeing new technology, as I said, with AI, robotic, quantum computing, biotech, that can also be supportive of growth. Now you have a lot of negatives that are coming as well. Obviously, inflation is something to keep on the watch, and inflation, as I'm going to show, tend to be sticky for many years. You have the liquidity is getting drained. You're seeing it. Central banks are not supportive anymore. Quite the opposite. And we had the Fed this week that was pretty hawkish again for what they're trying to do. And we obviously, as I said, very leverage and high leverage in the system. And finally, some regulatory, things that you need to keep on the watch. Obviously, that matters for cryptocurrency, that matters for the US banking system after the banking crisis that we had earlier this year. So overall, it's really like we have a trifecta of the debt problems that we've seen in the 1940s after the war, when we had so much debt because we had to build the war efforts. We have a little bit of the speculative environment still from the 1920s and late 1990s, and that we've seen it with the bubble that popped a little bit in tech, but it's coming back a little bit with AI. And finally, we have the inflation concern, like we had in the 70s, that were linked to some commodity sectors and commodities supply that disrupted a lot of the thing in the 70s. I'm going to stop here just from the 40,000 view. Is there any question on that side? Okay, so I'll continue.
There's a question in the chat, by the way.
I don't see the chat when I'm sharing. Let me see. Okay, many government, Russia, China, have been and are purchasing gold significantly. Do you have any thought on this? Could there be a return toward gold-backed currencies? Yeah, so I'm going to discuss that a little bit. Thank you for the question, Leah. It's an important question, and it's part of the de-dollarization and where you go. And there's not a lot of assets, safe assets that you can go after, and so gold is definitely part of the portfolio. You may want to have a portion of it in there. I think I have a graph on the case for gold somewhere. Here it is. So yes, so as I said, there's not a lot of alternative. People thought crypto would be, it still can be, but it hasn't been, as strong because of the shenanigans that is happening in the crypto space. But central banks have been buying, obviously, because as I said, some of the central banks are moving away from the dollar. Obviously, Russia is not buying our treasuries. China has, limited the amount of treasuries that they're buying, and they've been buying a lot of gold. And so usually, and that's surprising, right? Because when rates go up and real rates especially go up, you can graph real rates versus gold. When real rates go up, actually gold goes down, because gold there's nothing you can do. There's not a lot of application for gold besides being a safe asset. There's no carry. You're not getting any cash flow from it. And so therefore, when real yields tend to go up, people tend to, go and buy fixed income instead, because they get some cash flow and avoid gold. But as you can see, in the last 3 years, they just try to break even that 2100 area. And we had like 3 peaks, and we keep failing at that one. So, it's something. There's an underinvestment in mining. I think exploration mining stocks are still cheap. There's a little bit of a value trap there, and we can talk about that side. But overall, there's some new use cases for gold with batteries and some green product as well. So I don't mind having a small portion in gold. But in this case, I'd rather wait, especially the Fed is hawkish, real yields continue to go up. So I don't mind buying it closer to in the 1800 area, or if it breaks really above this 2100, then just go with the momentum and buy it at higher prices. So I'm watching it carefully right now, but being ready to act on a dip or if we break high. So,
I think I'm just a real quick question on that slide, just because I'm looking at a small laptop screen.
yeah.
Can you just tell me what year that starts? Because I see I just want to kind of get an idea of scale.
2002.
2002. Okay.
We were around like $350, and we're about 1900 at the moment.
Right. I mean, look, I'm on the same page as you. I mean, gold is good for teeth and adornment, and if there's a global apocalypse, I guess. But even if that happens, you're not going to be trading a bar of gold for some loaf of bread. So I tend to, if you're going to do it, probably favor more silver because of there's just more applications for it. But I'm not a huge fan of precious metals, to be honest.
Yeah, and I think if you're going to play it as well, you can play, as I said, some of the miners. The miners have amazing cash on cash. I mean, they're paying you a nice dividend on a yearly basis, some 7 to 9%. So why not at least get some cash flow? If gold keeps going up, miners, obviously there's an underinvestment, they're going to do well. So there's a whole there's a whole theory behind that. They haven't done well at all for so many years. It's frustrated a lot of people. So take with a grain of salt. There's a little bit of a value trap, as I said, with those.
Yeah.
But if you're going to diversify, why not get a little bit of cash flow as well from it?
I think that's fair. Don't over diversify, but a small portion of your portfolio can add a little stability.
Alex has a question. On Jan 23, Basel 3.1 went into effect. By Jan 28, all BA's monetary regulatory agencies, central bank shall have implemented the Basel 3 rule to their operational framework. These approaches shall cascade.
Oh boy, Alex.
A new global monetary is emerging. We have 5 years to anchor our emerging global monetary system.
Is there a question there?
Yeah, so I guess, this is part, Alex, of the de-dollarization and how you position for that in case really, we're starting to see more and more of that from emerging markets, from trade between Asia and other countries. Europe, even the French president, surprisingly, is saying that he wants to slowly move away from the dollar, trying to push his euro story out. So, there's a lot of things happening, and that requires, and again, in terms of as an investment thesis, is more like, add a little bit of diversification, add a little bit of international diversification. One, it's valued properly at the moment compared to the US, both emerging bonds and emerging stocks. So it's part of the whole story. And
my feeling is that no country other than the U.S. wants the U.S. to be the standard, to be the fiat currency. Every country wants to be the fiat currency. And all those that complain about it, what's the alternative? The euro? No, all the European countries complain against each other. It's going to be China or Russia. I mean, China, certainly not Russia, certainly not China. It's too unpredictable. So I just personally don't see an alternative that any other country could turn to, other than deciding on, with oil or some small or specific item that they decide to trade outside the dollar.
Yeah, no, I'm with you. I don't think you can replace the dollar as a reserve currency. I, for the last 20, 30 years of being in the market, I never bet against the US. I think it's always a bad idea. It's, one of the only country that has that great spirit, entrepreneurship, deep financial system, rule of law, and that you can't find anywhere else in the world. And so, that's not going away. I totally agree with that. And yes, I can share these slides with Liz, and so either send me an email at info@Wealthflow Partners, or I will send them to Liz as well, and we can put them in the vault. So let me go back to my slides. And again, I appreciate all the questions, and please keep asking them. That's what makes the dialogue and much more interesting than listening to me.
And Hicham, my point is there are people that are actually in the gold space relative to its value and buying power, right? And so that was really the context of that chat info that I just forwarded. Might be a good idea that after this session, I can connect you to them to kind of get some perspective as to what's really happening, right, relative to the gold as a tier one asset, right, for the lending institution. So to your point, or Chris' point, instead of relying on the U.S. fiat currency, there's a movement, or I should say, countries that are very much interested in using gold as the tier one asset to back up their currency instead of fiat. That was the essence of that statement.
Yeah. And then you see some fringe countries, who obviously the countries who had the most inflation like Zimbabwe and Venezuela and others trying to use crypto and go to digital, thinking that's going to change something. But yeah.
No, in reference to.
Sorry, Alex, I missed that last part.
Sorry, in reference to BRICS.
Yes, I mean, and I do like BRICS. I mean, I think, with I still think commodities are good assets to own as well, especially when in times of inflation, we have a chance that commodities are coming down because we're in the first valley of the inflation cycle, and that's the graph that you see in front of me. So I'll bounce on that. This is like inflation in the 1940s, the graph on the left. This is inflation in the 1970s. That's the graph on the right. I highlighted some of the similarities that we have in terms of indebtedness, in terms of supply and commodities under supply. And so, as you can see, every time there's been like 3 cycles of inflation peaks and valleys. And I feel like today we're getting to the bottom of the first valley after the COVID peak that we had in 21 and 22. And it's not a bad time during those to start buying commodities again. As I said, some of them have started coming down. Oil, ags, metals, because China has not picked up as people expected with the reopening. So people are pricing now because the Fed has increased rates so much, so fast, that there's a lag into the economy. Usually there's a 12 to 18 month lag. So we're literally just seeing the first impact of the first rate hikes right now. And so the bond markets, which is always, kind of the most forward-looking market in the world, has priced that. The inflation markets have priced this downtrend. The bond forward markets are pricing a little bit of a recession. We'll see it with things like yield curve inversion, with where the inflation markets are priced. And so that gives an opportunity, because obviously commodities don't do as well in recessions because there's less consumption of things, less consumers or less consumptions of goods, and trade goes down, and that's what we've seen. You're seeing it in the shipment index, you're seeing it in goods. Goods inflation has really collapsed, oil as well, and so it's not a bad time as a global investor to start putting money back in commodities. As I said, the investment thesis works as well, and if we go back to one of these peaks in the future, then you'll have time to sell at better prices when we get to that level. But for now, the markets are pricing more a recession. We're seeing all the leading indicators, both PMIs and whatnot, really collapsing, shipment and trade as well, as I said. And so inflation markets are pricing it right. We had the 4% print on the headline inflation this month. Next month it'll be at 3%. It's very easy to forecast one or a few months ahead, and my forecast is also for 3% next month. So the headlines are going to be like, okay, the Fed has beat inflation, blah blah blah, which is great. I don't mind it, but there's still some stickiness in services, as I said, and things are cyclical, as I can go back up. So for the rest of the year, I see inflation staying. The low should be in October at 2.8%. A lot of the indicators, as I said, there's a couple of indicators. As a macro investor, you look at. One is the leading indicators. Those are things like liquidity, what the Fed is doing with interest rates, mortgage rates, yield curves, and obviously PMIs, which tend to capture what's going on in the economy a little faster than some other indicators. Then there's cyclical indicators, which is more like in terms of sentiment, what CEOs are thinking, what the US consumer is thinking. housing start, feeling the impact of interest rates going higher. Obviously, any rate sensitive asset is going to start feeling, a little bit the pain of interest rates going up. And then there's what we call lagging indicators. So, employment, because everybody's talking, okay, employment is still very strong. We're still at, the lower end of the unemployment rate. But employment and GDP are kind of like looking in the back mirror of your car, and there's a 12 to 24 month lag into employment, and even employment, we're starting to see a little bit of things turning for employment. You're starting to see more and more states, seeing their employment rates going higher. Now there's 16 states that have seen a 50 basis point increase in their unemployment rates. You're starting to see the breadth of the employment, what they call coincident employment index, you see going down again, and same thing here on the bottom side, like going lower. So I feel like employment is going to start to take the brunt a little bit of what we're seeing in the leading indicators in the second half of the year. That's why I'm still seeing a little bit of a soft patch going into the end of the year and early 24. I don't think it's going to be dramatic. As I said, there's still a lot of cash in the system. There's still government spending that is helping. There's this new AI crave and investment that is going on. And the US as well is always more resilient than not. But just going back to the Fed policy, they told us on Wednesday that they're pausing, so that should have been good news, and maybe that's also why the stock market is bouncing a little bit, because thinking that, okay, we're at the peak and now we're going to go back lower, and that's what the markets are pricing. The markets are pricing 150 basis point cuts, so 1.5% cut into the end of 24. But the Fed on Wednesday told you the opposite. They told you that they're pausing. That doesn't mean that they're not going back to raising rates. Inflation is still too high, at least core inflation, even if I showed you that it's going to start going down pretty significantly this month and the end of the year. And they're not ready to cut rates at all. And they're nearly seeing that they moved up, the target rate from 5.1%, where we are today, to 5.6. So telling you that they might raise rates another 2 times 25 basis point in the next few months into year end. So, keeping monetary policy fairly tight. Again, that's usually something very important. Andy mentions M2 and quantitative tightening. And yes, M2 is an important part of what's going on in the cycle. That's just the Fed policy. You can look at those graphs when I send it. And M2 that Andy's talking about, as you can see, this is the red line has collapsed, right? So they're really negative. So meaning that they're taking money out of the system. It's negative minus 20% here. That shows that they're really tightening the screws for the financing. So anything that is interest rate sensitive should not benefit from what is going on in the system. Same thing, the leading economic indicators, you see it here, have collapsed in 23 and they're negative. So those are, all the leading economic indicators and PMIs. PMI is under 50 again, which is restrictive. And the curve, which remains one of the best predictors of a recession, as you see here, every time we had the curve going negative, meaning like the 3-month rate versus the 10-year rate, so the 10-year being smaller, at lower rates than the front end, you have a recession that is in red here. And the recession has been, more or less deep, depending on how long we stay inverted and how deep we are inverted. And as you can see today, this is one of the strongest inversion we've seen in many, many years. And it's been a while. We started being inverted for a couple of months now, And so the longer we stay here, the more inverted we stay here, technically, the worse the recession should be. I still not seeing a deep recession, how this indicator is telling us, but it's something to keep in mind. Obviously, any interest rate sensitive sector, as I said, is going to suffer just because, you're financing. If you have floating rates, you are going to get hurt. I mean, even like this is the US medium house yearly cost. So I'm just taking the mortgage rate, I'm multiplying by the medium housing price. Obviously, the medium house price has gone up, and now mortgage rates have gone up from 3% or sub 3%, in 21 to 6-7% today. So that means that your cost for the same house has gone up from, $10,000-$15,000 to $27,000 and more, nowadays. So obviously that takes the affordability, into question, and obviously that is hurting some of the housing sectors. We're seeing it. You're seeing a lot of your syndications, and that's a piece that Shane later is going to present during his talk on real estate, and especially in the due diligence part as well. We're going to discuss all these things, how you should be careful, what question you should ask your operators, and one of them being, what is your debt? Is it fixed debt? Is it floating rate debt? And if it's floating, how long do you have, interest only? All these things matter a whole lot nowadays. And also, if you have any syndication that has floating rates, they bought the property in 21 and now the floating rates have doubles on them. They can pay you back the coupons and the carry that they told you that you were going to receive a pref. They can pay, and sometimes they're calling capital, and you're seeing a lot of people even walking out of some properties, and we're going to discuss that all day today. Any question on that? Okay, so we'll have a lot of time to, and you can interrupt me anytime, but we'll have a lot of time to discuss all these things today when we talk about alternative investments. Employment, as I said, is a lagging indicator. It's also starting to feel the heat a little bit. We are, same thing, the same way your operator, yourself, if you have a small business loan, an SBA loan, people don't realize, they look at the Fed funds and mortgage rates, but small businesses are not financing at that rate. They're financing at Wall Street Journal Prime, which is now at 8.25%, plus usually 2 to 250 basis points. So small businesses right now are actually financing themselves at 10.5 to 11% from 5% a few years back. That is significant. That puts a dent on their bottom line, on their margins. That puts a dent on both the government. You're starting to see a very significant increase in interest payment from the government, and the government has a lot of debt, but also in the private sector, as I just mentioned. This thing is just to show how, to go back to what Alex was talking about, foreign holders, are buying less of our treasuries. And so at some point, if you have less buyers, someone needs to buy them. And if they can, there's a new equilibrium for where the rate should be, and it's higher rates, which again start hurting and compounding on all the other actors that I just mentioned. So that we don't have to be doom and gloom. I try to be a positive guys. I try to stay invested all the time. It's very, very difficult to just time the market. There's always a good investment out there. There's always a strong operator that is going to cash flow for you. We'll try to give you some examples today. That's the whole point of having the other sessions, and try to open your mind into other assets that you haven't thought about. So, in my investment thesis, obviously, and that's why I'm starting the next session on, debt funds, and funds that, where you can put your money right now, take action in managing your cash more efficiently than leaving it at the bank. Because for the first time in many, many years, savers have an option. You have an option to put money in money markets. You have an option to put money in debt funds that give you, 8 to 14%. And so, there's definitely a case for fixed income nowadays. High yield is paying better. And that's one of the main takeaway and investment thesis out there. On housing, as I said, I'm cautious. The supply demand dynamics still might favor you, although there's a lot of supply coming to market. And you can see it in one of the, maybe I didn't put the graph of, yes. So here, this is the supply coming to market, and this is a long-term graph. That's 1970s to today. We're having the most supply coming to market that we've seen in decades. And you're seeing it a lot in multifamily. And so that's why you have to be a little more cautious in what geography you're putting your money in. Florida, Texas, Arizona versus the Midwest versus the Northeast versus Michigan. And we can discuss all that. Obviously, not only rates are going higher, but the velocity of money is going lower because we had a banking crisis that took out some serious players. And small and medium-sized banks are literally the heart of America. They are the one who's lending. My mortgages, I don't have it with Chase or B of A. I have it with small lenders and medium-sized lenders. These guys are feeling the heat of what happened during the commercial crisis, and therefore, they're not going to lend as much, and that means the velocity of money is going lower, and that means the growth of the economy is going lower. So all that is important. Let's go back to the thesis. There's a case for commodities. I mentioned it with the underinvestment we had over the last few years, with low supply, with usually commodities are one of the best assets in times of inflation. And as I showed you, there's 3 peaks to inflation, so it should still be part of your portfolio. If you like commodities, obviously you have to like a little bit some emerging market, exposures. China, not rule of law, but it's still a big economic players. It's one of the few countries in the world right now that is gonna, keeping rates low and is probably gonna push for some to, try to help, its economy through government programs. So China, India, Brazil, Mexico, South Africa to a certain degree, not a bad place to have some diversified money in the end. The case for equities is a little tougher. As I said, as I showed before in some of the graph, there's some, equities, they follow what's happening in the economy. So if leading in economic indicators, if PMIs are going lower, equities tend to go lower historically. So that, plus the fact that liquidity is taken out of the system, is definitely it's not great. Now, people have been talking about this recession. It's the most anticipated recession in the world. People were underinvested. There's a lot of money in cash still that you can see in money markets. So, I think they can continue to grind a little higher, wash people out, and then, but you're at risk of seeing a sharp decline at some point. They're also not, on a relative value, they're not ideal. Tech is still very high. If you look at tech versus the S&P, tech is at a high again. If you look at the Russell 200, it's at a low versus, large cap and tech. So depending on the sector you're going in, and that's for good reasons, right? Because, small and mid caps, which is the Russell, it suffers from interest rate going higher. It suffers for costs going higher and margins lower for small and medium businesses. It suffers from from being in a, sensitive economic sector. And so, but at some point it will, it's a little cheap versus large cap and tech. So, small businesses, they are facing some headwinds with financing, with the cost of employment that's going higher, with cost of goods, but the cost of goods is finally coming lower, so that's not bad. And also, small businesses is an easy way, to cash flow, either as an operator yourself or or as an investment. And we'll talk about that. We have a special session on small businesses and franchising. The 60-40 portfolio, the same way like everything worked in the last 30 years for it, might face some headwinds. So, you have to be a little more active than a passive index investor, I think, over the next couple of years. This is telling you about my theory about tangible assets versus and physical assets, as compared to, financial assets. As you can see, tangible assets, which is hard assets, have moved from, in 1975, it was 83% of the index to being only 10%, right? So there is a case for that, and they're undervalued. Here you see commodities. That's the ratio of the commodity index versus the S&P, and you can see we're at multi-year low still, even with commodities where they are. So again, I don't mind diversifying a little bit into these. I'm going to try to go a little faster because we're at the end of the session. I want to keep answering questions. This is why this positive for growth. Obviously, I talked about the AI revolution, the infrastructure and Green Deal that we're having, the reinshoring. As you can see here, this is the industrial production. It stopped in the US from the 90s during the globalization years because it all went to China. That is changing, and that's a pretty positive. If we go back to what was happening before, from the 1950s to 1990s, well, there could be a very strong case for the US, staying strong at reinvesting locally and boosting, warehouses and building things again in a more efficient way with AI as well. This is just for crypto, and again, some portfolio ideas that you can read on your own. And one thing, we made all these sessions because I wanted to highlight alternative assets in retail portfolios as compared to sophisticated investment that pension and endowments are. So if you can see on this graph, that tells you how much a retail investor has in alternative assets. And alternative assets, I'll talk about what it means. They only have 5% of investments, when endowments, which is a more sophisticated investor, has 50% investment in alternative assets. And actually, they increased it even more over the last few years. So alternative assets could be private markets, that's real estate, that's private debt, that's some private equity funds, and then you have also liquid alternative, which is hedge fund, commodities, managed futures, different hedge fund strategies that you can have in your portfolio as well. And so that's just to raise your case for start understanding alternative assets, start putting your money in cash flowing alternative assets. I think over the long run you'll be in a better place to build financial freedom and time. So I'll stop here. I think I missed a couple of questions, and then please ask anything you want. We have a couple of minutes left.
Hey, Hitcham, Shane here. How are you?
Hey guys, sorry, what was that?
Can you hear me?
Yes.
Hey man, thanks for this. This is excellent. Yeah, quick question. You mentioned 50%. I didn't quite catch it. What you said, that alternative investments were 50 or 15? I'm trying to.
Yeah, so endowments, which is like your university endowments that is putting their same thing. They're growing their money to keep investing in the school, in the alumni, and all that stuff. and they're, pretty big in size, they don't put their money just in bonds and stocks. So 50% of their money still goes into very liquid stuff, bonds, stocks, and public markets, but 52% of their money goes into alternative assets in private equity, real estate, private debt funds and whatnot.
Yeah, that's excellent. Thanks.
If I missed any of your question, please feel free to just jump in and ask it, please. Okay. All right, well, I hope that was useful. There was a lot in there, so I apologize for putting too many slides and too many things, but global macro is such a wide array of assets and factors that I try to give you the high level view and then dig down into it. Again, if you have any questions, please reach out to Liz or you can reach out to me as well at info@Wealthflow Partners. Cool. Well, we're going to use the same link, I think, right, Liz, for all the sessions. So you can come back to the same ones. We're going to start the other one as soon as our presenters show up in a few minutes. And I'll start presenting them for, I'm going to stop sharing. And thank you for being here today.
Thank you for presenting. That was a lot of very comprehensive, great information, Hikam.
My pleasure, Chris, and thank you for the good questions. Great. So I see that we have amazing presenters coming online. We have Rob Seacrest and Beau Parfait. I will just wait a few minutes to give a chance to the people who are coming just for this session. So you can go grab a drink.
Rob, how you doing?
I'm doing well, and yourself?
I'm good, thanks. Keep hearing great things about you and your company, so excited to learn more.
Awesome. Yeah, I'm looking forward to this.
Well, I think we have a few minutes. I'm going to take them up on that offer. I'm going to fill my water glass.
Okay.
I'll be right back.
All right, my man. Thanks.
All right, guys, it's 11 o'clock and we're moving on to the next session. This one is going to focus mainly on fixed income and debt funds. I wanted to have this first session because this is something that this is one of the easiest and actionable item that you can take away from today. As I said, for the first time in many years, the markets are giving you yield that you can, for savers. And so for any cash management, I think you need to look at, a couple of options. And we're going to discuss a couple of various public market options, and also in the spirit of this, seminar and summit, in getting you to understand also alternative assets. And in debt funds, there's also alternative debt funds. And that's where my two, and I'm so excited to have them here. They're one of my, one of the smartest people I know. They have built amazing companies, and they're going to talk about their companies. Each of them is very specific. And in the alternative space, they offer you great yield. And we're going to discuss also some of the due diligence that you need to take when you invest in debt funds or funds that are going to be basically lending your money, hard money lending or something, because there's a lot of important factors that you need to take into account in your due diligence. And hopefully Rob and Bo are going to show you their process and why they're doing things right in managing the loan to value, loan to cost, and all the acronyms that are going to come out of this session. But first, let me introduce Rob Seacrest. He's the founder of Pillars Equity Group. It's an alternative debt fund that invests in real estate for cannabis businesses. He has years and years of experience as a lender. They are, I think, the biggest lender in the cannabis space. Having lent more, close to $500 million or more actually, and he'll describe a little bit his company. And my good friend also, Bo Parfait, who works for DLP Capital. DLP Capital is a very unique company, and I hope Bo is going to share with us a little bit, not only the fund itself, but also the spirit behind the fund. And they're an amazing firm that care about the communities they're investing in. Their CEO, and if you haven't read it, I highly recommend. Sorry, we can't see the book because it's in my building. The organization is a phenomenal book, and he can talk a little bit about their firm. Bo is not only a financier; he had years and years at in the markets with JP Morgan, and building his own companies. But most importantly, he's also an amazing human being who, in the spirit of DLP as well, he has climbed the 7 peaks. Not everybody, when everybody is in south of France, getting ready to get on a boat in Cannes, he is at the Mount Everest. So that just tells you about the character and the rigor that he puts in his work. So guys, I will let you introduce yourself, introduce your firms, and then we'll have a dialogue. Thank you.
Go ahead, though.
Well, thank you for the warm introduction. It's an honor and privilege to be here. Thank you for everyone on the call that's carved out time out of their busy day to be here. That doesn't go unnoticed. Again, my name is Bo Parfait. I am a managing principal at DLP Capital. We're about a $4 or $5 billion real estate firm, and we have our mission is to solve the workforce housing crisis in America. So that's our mission. is to solve the market rate workforce housing crisis in America. And we do that kind of through our debt funds and our equity funds, which we'll probably get into later. Our CEO is a very dynamic guy. His name is Don Wenner. And as you just saw, he wrote a book called Building an Elite Organization, which is a phenomenal book. Definitely check it out. It's a managerial operating system, how you can grow and scale your business. And it is a really cool book. And that is a little bit about me. And you heard that I did climb Mount Everest. I was lucky enough to make it to the top. Anyone that says climbing Mount Everest is easy, in my humble opinion, hasn't done it, because it is hard. And it's there's real risks. I think there were 14 deaths last year on Everest, this year on Everest. So, but with that said, honored to be here. Thank you so much. And with that, I'd like to pass the baton to my friend Rob.
Well, thanks, Hitcham. Thanks for having us here. And I think that this is a great balance between two debt funds in different asset classes. I feel like I might need to be writing a book myself here. So maybe I'll have to figure out what my topic might be. But the best I've done has been to the base camp of Mount Everest. But we'll have to. That was the intent, was not to go up. So. So I'm Rob Seacrest, president and co-founder of Polaris Equity Group. We have originated several $1 billion of transactions, and in 2016 we decided to pivot to cannabis. And today we're the largest privately held lender in the country for lending to cannabis use properties. We launched our fund in 2018, and that fund purely does specialty use properties for cannabis, and its most similar asset class to cold storage, data centers, or lab space. And the reason that we pivoted to this sector is that the economics in this sector, there was nobody here doing it, and we were able to get bank quality sponsors, loan to cost transactions at 60 to 75% loan to cost. In transactions and beginning, 15% coupons on those transactions. And it's just a phenomenal asset class. But I think the most important thing is that in this specific asset class, it's going to be less impacted from a real estate or economic downturn than traditional asset classes. And that's just because the revenue for this industry, which is $27 billion a year, and growing to 45 billion in the next 3 years, that revenue is going to flow regardless of what's happening in the rest of the country. And that's because it starts with $25 to $75 at a dispensary or delivery service for cannabis, and people are going to still buy alcohol and cannabis and different other form factors of cannabis. And so these borrowers are not trying to flip these properties. They're not trying to sell them for a profit. They're not developing them on spec. They're building them for themselves, and they don't move, they don't sell, and they just try to make them more efficient and generate cash flow. So I'll stop there and let Hitcham kind of lead the way here.
Thank you, guys. Yes. So I just wanted to first, let's just get into it and understand, the basics. So what you as investors can get from these is, one, having, tremendous organization who have, decent means. Also, you want to think about, as a worst case scenario, when you do lending and you do asset-backed lending, meaning that you lend against the real assets behind it, which is Rob is doing with the real estate that is linked to a cannabis operator. He doesn't lend to cannabis, he lends on the real estate. And that's going to be a very important differentiation that he will talk about. But, part of the due diligence is really to understand, how they're structuring their deal. But what you can expect is usually going to be a higher yield for you. And I think what these funds are offering is, getting you to, the money market fund, for example, will probably give you 5%. And there's a portion of your money that needs to be some money that needs to be used, or savings that you need to be ready if you have something coming up in the next 6 months. But then there's other alternatives that are, technically a little bit risky, but we try to minimize that risk, that will give you a higher return. So, in both DLP and Pelor's fund, you can tend to see like 8 to 14%, call it, returns over time. The other interesting things about their fund is that, they're very conservative into who they lend and how much they lend. And that's very important. Again, we're going to see it in the due diligence part of it, because at some point, something goes wrong, these two operators can take over the asset, and they can run that asset. And so not everybody can run that. So you have bond funds that they have no clue how to run an asset. As a worst case scenario with these two firms, they can take it over and run it. And because they have a low loan to value, there's a really high chance that they're going to recuperate most of your on it, if not more. So that's one thing. So they'll offer you higher yield, a little more security by the firm they are, and also there's a liquidity component. So it's not something, most of the real assets that the other alternative assets, let's say you're going to invest in a real estate syndication, well, you're supposed to put your money and not expect it for the next 5 to 7 years. You will get a coupon on a yearly basis, but the liquidity of that assets is not going to be there for you if you need it tomorrow. In the case of these two funds that we're talking about and some of the alternative bond funds that we can discuss, you are able to get your money by giving, in the case, both of these institutions, I think within 30 to 90 days, you can get your money back. So, having that higher yield, but also that liquidity, on a risk reward basis and liquidity basis, that's how you have to look at these things. How much risk are they taking? Is that worth the extra yield? And then in terms of liquidity, how fast can I get my money back? And they'll explain, each one of them will explain, and maybe they can cake with Rob and his fund, how he manages that and how he gets the higher yield and how he provides you the liquidity.
Sure, I can touch on that in a high level. We came from traditional asset-based lending prior to pivoting here. And, in traditional lending, you're looking at the value of the property, whether that's a cost basis, a comp basis, or an income approach, or a blend of all three of those. And you're taking your experience of understanding locations and other things that don't get implied or imputed through in those valuations. And you're looking at the sponsor of that transaction, who would be the guarantor, the person that backs that. And you're looking at their experience and who is going to be the tenant, if it's commercial or if it's income producing, or what's the exit strategy on that transaction. And so in looking at that typical model in very established industries, fix and flip, hotels, industrial, whatever it might be, those industries are fully mature, and there's indicating market data out there that will show you what's happening almost effectively in real time if you're using Coast or Reese or CoStar and other types of things like that. When we entered the cannabis sector, being the first in the sector, we knew that there was no comps out there. There's no sales comps, and there's no income approach to develop these modelings that you would typically use in underwriting. And so when you're faced with that type of situation, there's solutions to that. And typically what you're going to utilize is a cost basis, because basically for every dollar that somebody puts into something, that was a true spend that they had to do. And so we started underwriting in the sector off of a cost basis, not LTV. And what we had learned and doing similar to what Bo's done and lots of other asset-based lenders is there's a certain threshold that most lenders have learned, what we call skin in the game, that is a threshold that borrowers will not walk away from. For our lending experience in California, that was no less than 25% hard cash into the transaction. When we started originating in cannabis, we required that to go up to 40%. But more importantly, because there was no banks actually doing this type of asset class at the time, we also were able to improve the quality of the sponsor from traditional asset-based lending, where you're adjusting for the lack of liquidity or income from that particular sponsor, or even a guarantee, by reducing the loan to value or loan to cost to offset with that extra equity cushion by them putting up the cash. Well, in this sector, not only did we get the additional equity of up to 40%, but we also got bank quality sponsors, because these were very sophisticated people that just simply had no other alternative to find a debt solution, and were using up all their equity out there. And so that modeling, and that's great as you're emerging into the sector. But as the market developed, we realized that most of the time you don't need to be an expert in pharmacies or running a hotel or running a manufacturing facility for durable goods, because all those market comps are out there, and you could just go off of the financials of the borrower or the tenant that's going to be in there. But what we realized in cannabis is that the sector is so much more nuanced, and there's so much more data points that needed to be considered from experience in de-risking the deal, that we actually built a separate company, a data company, and we started aggregating all of our own information as it relates for cannabis to real estate, not to the cannabis operators. There's all kinds of data points out there for how the cannabis brands are doing, taxes that are being collected in each state, but nobody had any data for the real estate. And so we went out and we mapped all 45,000 licenses across the country, who owns them, what types of licenses they are, where are they geographically located, how many licenses do they own. And we assembled all that information into our own database, and then we update that every single month. And we started mapping that and plotting it. And then we started developing and pulling and extracting our own means of averages for what the cost should be for this particular type of industry, this particular property, or these line items. And so today, that data company is producing data that is so important that we could probably switch to being a hedge fund model and start betting on the stocks if we wanted to, with a very good high level of information of being projecting what's going to happen in the sector. So what we're trying to understand is make sure that we're not lending into any particular state that has too much cultivation already built, too many dispensaries already built. That we're trying to understand what life cycle each one of these single states is at in its maturation to being a fully stabilized market, and where that will shake out to be. And we're also trying to understand, because we have the most data points of anybody in the world probably at this point, we're trying to pull all that data back in, and we're trying to establish those means. We anonymize it, and then we flash it back to our existing borrowers, or we're utilizing in our underwriting. And I'll just give you just two high-level examples. We have some borrowers that are so far outperforming the mean that we actually stopped our origination to go out there and understand what is it that is putting you so far out on profitability compared to everybody else. And for example, the two easiest ones to describe was there was a trimming machine that reduced the labor cost of when you harvest a crop, you have to trim the flower by hand. It took 11 people a week to do each room that they processed. They were able to put in a new technology trimming machine that was automated that took 2 people one day, and it saved them 80% in labor, or 1.2 million a year, just added to the bottom line. Another one was that LED lighting has come so far since the industry started that we had a borrower that did 2 rooms exactly the same, one with halogen and one with LED, and they were able to pick up 20 to 30% consistently higher yields from the LED, because the technology's gotten so advanced. And so we pulled all that information in, and for our existing portfolio, we flashed that back to the existing borrowers. We say, hey, look, you have twice the amount of people that most people have doing the same exact job. You might want to consider doing this to become more profitable. It's not required by them, but it's just a suggestion. We're still only a lender, we're not a partner. On the other side, though, when transactions are coming into us and we're looking and reviewing the budget, we say, hey, we don't see that you have any of these items. We might want to suggest that you consider them, and or go fly to one of our facilities that has that, one of our borrowers' facilities that has that, and understand how this can impact your bottom line. And so why I'm going this deep into this is that this is the level that we think about things. This is how deep and how far we're willing to go to improve our underwriting and understand the nature of the sector. I'll stop there.
Yeah, that's amazing. Yeah, so that just shows again the level of details that these people are doing things, and they're when you look at funds to invest, you want to stay as close as, especially in the alternative space. There's a lot of things, and sometimes it's harder because you don't have the information. But try to stay as close as possible to institutional player as you can. And at this point, these two firms are definitely institutional. So, Bo, you want to give us a little bit of a hint on how you operate at DLP and how you create that yield and liquidity?
Yeah, absolutely. Hitchem, no problem. And Rob, I always enjoy listening to you talk. I always learn a lot of things. So great job. Yeah, you're welcome. So I want to start off just with three quick things. Okay. So the first thing I'm going to talk about is just this huge shift, or this big movement of ground that's happening worldwide, which I think is pretty fascinating. Number two, I'm going to talk about kind of the banking industry really quickly, what's going on there. And then number three, I'll give kind of a nickel tour of kind of how DLP does lending. And I'm going to move pretty quick. So here we go. All right. Number one is amazing disruption is happening in the world. So Amazon has disrupted retail. Who would have thought the largest taxi cab company in the world wouldn't own a single taxi, right? Uber and Lyft. Who would have thought the largest hotel operator in the world wouldn't own a single hotel room until recently, right? So you've got Airbnb and VRBO. So there's these big movements happening around, this disruption, the innovation. It's fascinating. The same thing is happening with wealth management. Okay. And, I happen to pick on a big wirehouse, a Merrill Lynch or Wells Fargo. If many of them say what I'm about to say, but many of them don't. I want to just say that I'm balanced, but they do not have access to the whole world. They have access, and you can do the math. They have access to less than 1% of the investments that are available in the world. So if your financial advisor says to you, hey, I want all of your money and I can diversify it, we have open architecture, that's a departure from the truth, everybody. That is a departure from the truth. They have very limited access to things. And again, less than 1% of what's out there. I'm happy to put some numbers around it to people, but that's point one. So there's this big movement of ground to finding, right. And someone just Leah wrote, they can't sell away. So Merrill Lynch, for example, can only sell the products on their platform. So like Rob's company, right? You couldn't invest in Rob's company from Merrill Lynch, right? Or DLP. So many great companies there will never be on a Merrill Lynch or Wells Fargo, or JP Morgan platform. They're just not going to be, for a whole host of reasons. So there's a conflict there for sure. And please, if you're for those that are leaning into this and taking notes, it's absolutely true. So you're right. So Leah just wrote, sadly, the vast majority of investors, savers will never look beyond what is presented to them. And that's true. So there's some really cool masterminds and groups like the one we're on today that's kind of helping this huge revolution happening or movement, that there are a lot of good investments that aren't on a just quote unquote Merrill Lynch platform. So push beyond and look beyond. So that's point one. Point two is the banking industry. So the total number of banks in 2000 was about 8,200. There's about 8,200 banks in 2000. Roughly today, there's about 4,400 banks. So it's almost half as many. Well, what happened? Well, a lot of banks in 2008 and 9 went out of business, but there's a lot of mergers and acquisitions that are happening as well. So there's less banks out there, which has really provided more opportunity for private lenders to have more growth. Now, private lending has been around for hundreds and hundreds of years, but it's really had a nice growth because private lenders are faster and they can underwrite things more quickly than a traditional bank. Okay, so that's point two: is the traditional banking industry is getting smaller, while the private lenders are getting bigger, which is good news for private lenders. I think it's good news for investors too. and again, they're both good. I mean, and I don't want to say one's better than the other. I'm not saying that. I'm just saying there's a difference, and they both serve different aspects of the market. Okay, so that's point 2. Point 3 is real estate lending. So DLP is a sizable real estate lender. We have approximately $1 billion of loans. We like lending money to people that are mainly trying to solve this market rate workforce housing crisis in America. So if you are thinking of, hey, I want to allocate capital to something, you should look at who's the underlying customer, what's the demographic. And there is a shortage, and again, depending on what research you read, about a 5 to 6 million shortage of workforce housing in America, 5 to 6 million shortage of supply. So when DLP makes a loan to one of our talented real estate operators, and they're providing this product to the market, it leases or sells like hotcakes because there's just such a shortage of them. So the underlying thesis, the underlying demographic is very important to understand and figure out if you're deciding to allocate capital to anything, like who's the underlying customer. So that's very important. And then, as Hitcham also said, is, well, what happens if things go wrong? So at DLP, we have 90-day at a high level, we have 90-day liquidity. We're making shorter term loans by nature. So these are construction loans or bridge loans, and on average, our loans are paid off in about 10 months or so. So if you think about it, if 3 months goes by, roughly 30% of our portfolio is turned over. So there's kind of a built-in liquidity feature there, which is nice. And the reason why some of you may be asking, hey, how come traditional banks don't do this? Well, bridge loans and construction loans are a different demographic, and traditional banks prefer to do more permanent financing, where it's already built or rehabbed and stabilized. It's a safer loan because you're not taking on construction risk. Okay. So, and DLP, our loan to cost is kind of in that 70s range, and our loan to value is in that mid to low 50s range. And, if God forbid something goes wrong, we, as the first lien lender, you own the asset. And if the loan
can we stop on that? Because that's a very important point. And
sure.
I don't know if everybody's sophisticated enough with the understanding what, LTV means and LTC. But, you want to explain it quickly to people, like the loan to value and replacement cost?
Yep, for sure. So a lot of lenders will look at things, and a great question to ask someone is, okay, you made a loan to someone. What's your loan to cost, or what's your loan to value? Okay. And, the loan to cost is, okay, what is you're getting a loan, and you're let's just say in this you're building something, you're building apartments. Okay. Or 10 single family homes or 100 single family homes that you want to rent out. So you're building a real estate project, and what's your cost? So say the cost, just to keep the number, is $10 million. Okay, great. We'll loan you, 7.2 million. Okay, well, that's 72% loan to cost. It means that the real estate operator that you're lending to has put up, a significant amount of equity, which is good. And Rob touched on this. They have to have skin in the game. That's very important. And then they go build whatever they're going to build. And then when it's finished, it has more value, right? The value is mushroomed because if it's an apartment building, it's now full, and that has higher value. So that's why you see the loan to value I think at DLP currently we're about 53% loan to value. Which is important. And somebody asked, well, what happens if they're 80% done with the project and the real estate operator goes belly up, or something goes wrong? Well, if you think about it, that's the least risky part of the loan, because they're 80% done. So the loan is less risky now than it was, 10 months ago or 12 months ago, because they're 80% done with the project, right? They've put a lot of effort and work into it, which is fabulous. So, if we don't want to, so to be clear, we don't want to take over the asset. Some people lend at really high loan to value or loan to cost. And, and that's just not what we do. Some people call that predatory lending. That's a whole separate discussion. That's a whole separate asset class. It's a whole demographic of people. So to be clear, that's not what we do. But you're cheering on the lender. We're helping them to succeed as fast and quickly as they can. So that's what loan to value is when it's built. Hey, we could go sell this thing, or the value is now worth, just say now the value is worth 100 million, just to make up numbers. And, our loan is 52% of the 100 million in this example. So the risk has gone down significantly. So that's how you can think about loan to value and loan to cost.
If I could add to that, Hitcham, if you wouldn't mind,
Yeah.
being from this lending sector, I think that I've spent time with Bo and seen him pitch and know lots about what they're doing, and it's an amazing structure of fund. One of the things that I think is amazing is that they pay their pref and their stuff before they take their management fee. I've never seen that from any other fund. That's something that's massive, I think. But I think that something that is very important, and Bo, the core of your investment thesis is there, but I really think you should pound the table on it. It's just as important as the sector that you're lending in. You're not specialties, but you kind of are, because it is a specialty asset class. And similar to us, you have an asset class that I think is going to, when you're in that affordable category in a workforce, that is a sector that's going to make it through market downturns, just like us. But you have a much larger universe of a market to be in, and more traditional. But I think that is something that is so important about your business model, is that there's always going to be real estate cycles in the general macro markets, and not only from the real estate side, but the economic side. And nobody's going to come through those market changes or waves unscathed completely. But what you're trying to do, all the assets, equities, debt, investments, and everything that you have, and say, okay, what percentage of my portfolio do I want in alternatives that are going to hedge my bets as we go through these cycles, whether they're in 3 years, 5 years, or 30 years, whatever it might be, and which of these assets are inflation protected in a sense, that they are not going to have, if I have to redeem my shares, I'm not, because the market is down. And I just think that these are things that people should be thinking on the macro level, whether they're investing with us or with other alternative asset managers. But these are the core thesis. I think before you make any investment in any fund or anything, you should develop, what is it that you're looking for? Before you go buy a car, you should think about, what is it that I'm trying to solve for? Is it a family car? Is it a sports car? What's the price? Come up with your thesis, and then start looking for things in that thesis that match that in each one of those categories that you're going to allocate to. So I think that that's how I would be thinking about how my portfolio would be. I would have some with an asset manager. I would be looking at what their blend is, and then I'd look at how does that fit into my overall portfolio, especially in the fact that you can't sell away. They don't have access to some of these investments and things like that. So that was my comment. Long-winded.
Great comments, Rob. Great comments, Rob. Go ahead.
Yeah.
Richard.
No, it's key, and I agree with you. There's, the niche sector that you're looking at is very important to see how resilient it can be in good times and in bad times. And we're seeing it even because Bo is in the housing market, which, as I mentioned before in my previous session, is a little bit shaky for some operators. But for someone who does affordable housing and the way to do it, the structure that they have, you still feel safe and sleep at night versus other operators that are out there.
Agreed. And Rob, just to dovetail off that, so Class A apartments or Class A office, I mean, office space has a headwind right now, right? People are working from home, there's a hybrid work situation. Companies have been downsizing because they don't need such a big footprint. So Class A office has some headwinds. Class A apartments, this is reasonable to say, when there's some market turmoil, rising interest rates or rising inflation, people tend to trade down a little bit. Hey, I can't quite afford that Class A apartment, or I could, but if I just traded down a little bit, then I'd have more disposable income. So, there's some headwinds there. So we do feel, with humble confidence, knock on wood, that, the market rate workforce housing there's such a supply gap that, we feel, again, with humble confidence that, we still have tremendous demand for what we're producing. So, let's hope that continues.
And Bo, I'm just going to jump on the question, a great question that Julie asked. She said, does your company sell non-performing note to individual investor, or do you work them out yourself? I think one other tremendous important thing about your firm is that you're integrated. You have a construction business. You have people who have done that for 30 years. And so in a way, when you were giving your example of someone bailing out when they're 80% done, well, it's nearly, you would like that to happen more often than not, because then you take over, you know how to finish it to 100% because you have the crews, you have the construction, and you're getting an asset at a low percentage, and therefore you're still ahead after that. Can you speak a little bit on that?
Yep, sure. So we have about $1 billion of loans. Our lending fund launched in 2014. Historically has done over 10% net. There's monthly distributions, as I said before, 90-day liquidity. It also qualifies for this really cool thing called QBI, the Qualified Business Income Tax Deduction, because it's a mortgage pool REIT. So there's a 20% tax savings there that you can check out. But Don said this I think a week or two ago, the lending fund has done approximately 5,000 loans, and 1% of those have come into some form of a workout or delay. So I think that is a testament to how good of a lender DLP is. I'd also be remiss if I didn't mention that Don and some of our larger investors recently bought a traditional bank, which is very hard to do. You can Google it, but it's the Community State Bank of Florida. It's based in Stark, Florida. So to get approved to buy a bank, you have to pass a really extensive background check by the Fed, the FDIC, and the Florida state regulators. So I think DLP is a pretty good lender. So what happens when something goes wrong? Let's talk about it. So about 98% of DLP's loans are current. And then there's ones that aren't current that kind of fall into this next bucket, which are just delinquent. So from 31 to 90 days, we've got this delinquent bucket, and 2% fall into that bucket. Well, what happens there? Well, sometimes it may just be people need more time. They need another 1 or 2 or 3 months. The construction project's taking a little longer. Maybe they had a sub they had to swap out subs, and all that's okay. And Hitcham, you said something great. So DLP, the cool thing is DLP is more than a lender. We're an owner operator ourselves. So maybe it's our head of construction coming into that project, Jim Boyce, and helping them get through some sticky situations. So it's kind of an all hands on deck to help them. Okay. Versus another firm that may just say, you're behind, and when are you going to pay us? And we're going to maybe get aggressive with you. We're the opposite of that. Is how can we help you? And frankly, in that 31 to 91 days, we're able to sort out, again, of the 2% that go into this bucket, about 1.39% are sorted out within 31 to 91 days because we're there to help. And we're fully integrated. Oh, you need a sub? We may take a sub from another market and say, hey, they're going to come to your market and they'll be there for 3 weeks and they'll finish the project. So we're there to help. And then now let's go into the last little bucket, which is like, 0.6%. I mean, it's such a small fraction. So now now they're really in trouble. Well, we're going to try to work with that borrower again to approach them with a warm heart and say, okay, hey, you're really in trouble here. We either DLP will buy the loan, we'll take it over. We could put it in, one of our housing fund or our building communities fund. We'll buy it, at par and with the current interest rate. So the lending fund is totally square, not impaired. So we can buy it, or we go to one of the 200 real estate operators that we work with around the country, and they'll buy it. And many of them will be chomping at the bit to buy it because, there's a lot of value still on the table. And if those things don't work, again, we can work with them in a lot of different ways. In the worst case scenarios, we do have to, foreclose, and kind of use the legal system to buy the loan. Very rare that happens, but if it does, we can go down that path.
Thank you both for those precisions, and just to give some more props to DLP as well, is he didn't mention it, but they live and drive by that mission, and the clearest example of that is what they give back to their philanthropy. So Bo, maybe I'll give you 2 seconds, and then I'll bounce back to Rob for more questions.
No, I'm glad you said that. So thank you. So DLP gives not 1%, not 2%, not 3%, not 5%, not 10%, but 25% of DLP's profits go to the DLP Foundation. So remember, our mission is to solve this workforce housing crisis. What about homelessness? Right? Those are hard to make pencil out. So our foundation is really focused on homelessness. So there's a lot we can do with our charity that to give back in that sense. So that's a big part of DLP's values. And on that note, a lot of people remember during COVID, if someone was behind on their rent, you couldn't kick them out of the apartment. We heard so many operators, send the nasty notes or knock on the door and say, you're 2 months late, you're 3 months late, and here are all these fees and you're in big trouble. We just took the opposite approach. We'd knock on their door and say, hey, how can we help you? Oh, I lost my job, and great. Oh, that's terrible. How can we help? Your resume needs to be updated. Great. We'll help you update your resume. What is your skill set? Let us use our HR team to find you a job. And we did wonderful through COVID, because when you approach it with just, a warm heart, it's amazing what can happen. So thank you we're big on charity. We're big on giving back. So thank you for letting us touch base on that a second.
No, it's quite incredible. Thank you for that. And so Rob, let's bounce back, because you're one of my favorite brains for lending. You've done that a long time. You helped me go through, sometimes asking, questions and seeing how we can structure things in a better way. So what questions should people who want to invest for the first time in a debt fund, what should they be aware of? What are the main questions they should be asking?
That's a tough question as a broad factor. So, I would always start with audited financials. I'll just kind of touch on the top one. Bo and I happen to use the same auditor, Cohen Resnick. That is relying on a third party that has to sign their name on that. I think that's an important aspect. I also would, I don't think that most people thought much about counterparty risk until SVB banking crisis. But I think that all asset managers think about that. And I think that that as you work with smaller organizations, they may not have the experience, been through multiple market cycles, to know to watch out for those things. So there's counterparty risks that may not be associated with the fund that you're thinking about, but it is related. And if your bank failed and you had more than $250,000 of deposits, that investment account, that could be a significant problem, obviously. And so what's your recourse? Suing the fund, and there, that's not going to be a great solution to come out of that. So, but there's other counterparty risk. There's treasury management. There is other things that have to be thought through. Now, our auditor does go through to those extents, and COVID was a layer was added in for that. Cybersecurity was added for that. So a lot of those things are being done by top tier auditors. Now, some smaller funds may not be able to afford a top tier auditor. That's not to say that they're a bad fund, and you have to be making business decisions at different levels of the operation that you're at. Obviously, you're not going to spend $200,000 for an audit of a fund that's managing $5 million. The other thing that on this counterparty risk, because everybody thinks about the core risk of the fund and how it's managed and all that stuff, but the other part that I think is extremely important is that the level of counsel that they're using. Legal counsel is enormously expensive. Anywhere from $400 an hour from some of our low tier things that we're doing to $1,500 to a higher tier. And the thing is that those legal bills can be $200,000 a month. We've had them as high as $500,000 a month. But the reason that we're spending that money is that we're protecting equity positions. We're protecting assets. Our total portfolio is worth probably $700 million. There's hundreds of millions of dollars of equity. We're not going to chintz on getting top tier legal advice on how to navigate something proactively or reactively after we're having to deal with something to save a couple of bucks. It's just insane. And so why I say that is that when you're working with top tier legal firms, our firm wrote the documents for most largest REITs in the country, including BlackRock or BREIT and many other of them out there. And so the wealth of experience and the velocity of transactions that top tier firms are doing, that experience, they're seeing the velocity of things that other smaller tier firms may have never seen or dealt with before. And so, yeah, you're spending $1,500 or $500, whatever it might be. You might have 8 freaking attorneys on the call that are all $1,000, and it's freaking painful, especially if somebody's late for the call. But that investment is they're all freaking first world problems. That level of knowing what's happening in real time across the country is what you're paying for. And so I always try to remind people, it's not just the core stuff. You have to think tangentially. What are the third parties they're using? Who are the attorneys they're using? Is it consummate that those counterparties for the level of business? Obviously, we couldn't use our law firms that we are using today when we launched. So you can't. You just got to go with what you can at the time, but. You don't want to see your fund or your managers chintzing on things. You want to use top service providers, the best that you can for each of those things. And the other thing that I try to say is that the fund should always be thinking about how to utilize the third parties to minimize their overhead so that they can operate as most efficiently as the market cycles change. The reason that lenders go out of business so quickly in the institutional lending world is that all that portfolio is not on their balance sheet. And so if they're not originating, they're out of business. And so if they see that the rates go up, they have to just shut down the whole company because they don't have enough origination fees to support that staff. And you have to think about that. Whoa, wait a minute. What do you mean? They have to originate to stay alive? I'm not so sure I want to be in a company that's having to originate to stay alive as we go through a downturn. So there are opportunities in a downturn too, just as well. But you just need to be thinking about things that are not the core of what you typically think about. And I think you've got two asset managers here that really can help open your eyes up to thinking about things on a more broader perspective. Pick your lane, pick your asset manager, look at, speak to their investors, look at their track record. But more importantly, you also have to be thinking about, how do I think about all investments, all managers? What are the things that I want to have as my due diligence list? And so, again, super long-winded answer, but these are the things that I think that people blaze right past.
Yep. Can I double click on this a second? Is that okay? Okay. So this is a big one. I'm a fan of a top 10 auditor. I'm a big fan of it for anyone wants to allocate capital. And I'm also a big fan of what Rob said, like, having a top tier law firm, involved doing the documents. I can't tell you how many times I've heard over the years, oh, my brother-in-law or my friend is a lawyer and I did my fund docs for $5,000. I mean, that's that's just a bad sign. And then, because there's a lot of things in the documents that will protect the LP or the minority partner that should be in there, right? And if you have, your uncle or somebody do it, they can omit those standard things, and you as an investor will not benefit from some of those rights, those limited partner rights that you should have. The other thing that I like is I want to read the monthly and quarterly reports, right? I want to see how that real estate operator or that fund manager, what are they thinking about the market? What are they saying every month or every quarter? Are they on top of what's happening at a macro and micro level, right? What's the thoughtfulness of those reports? That's a big one. I like a data room, so at DLP, for example, we have a data room. Our entire loan tape is disclosed. Here's the loan tape. Here's where it is. Is it performing? Is it not performing? How many loans got paid off this month? How many new originations did we make? In DLP's quarterly report, we highlight borrowers that we work with. So do they, an investor portal is really important, right? Can I log in and see my statements? So there's so many things to kind of unpack here, but it is, and as Rob said, it's not to say that some small lender that can't afford an audit is bad. It's just you're just taking on more risk. And it's more about trust at that point. So, but again, it comes down to the person on what level of risk they want to take. So anyway, I just wanted to double click on that a minute.
That's tremendous, guys. Thank you so much. Because I am so big on due diligence and being careful, because you could have 95% of your investment do well, and a 5% where you're maybe overweight on it versus other things will kill all your returns for the last couple of years and create a lot of headaches and nightmares. And so we'll have a special session on due diligence with Bruce, Mike, and Hans later. But super big on that, and thank you for that transparency, guys, and how you run your business. I think there's one question in there in terms of taxes, because obviously people who invest in the alternative space like to have some tax advantages as well. But I know for Chris, it's like, it's a 1099 instead of a K1. For some of the housing funds in your DLP fund, you can get some tax advantages. So if you want to talk about it for 2 seconds, and then I'll bounce on other alternative for people just to open their mind, and then we'll go to the next session. And that's been amazing. Thank you.
Perfect. So thanks, Chad, for the question. I'm going quickly here. Our debt funds have 1099s. And again, they qualify for that QBI, that qualified business income tax deduction, which is a real savings. On the equity side, so we have a housing fund, which is primarily just value add apartments. That fund is pretty cool because, the K1 there, which comes out on time, has historically showed about a 1 or 2% loss. So you're growing your wealth tax deferred, which is pretty darn cool. How are you doing that? Again, a lot of it's because inside the fund, we 1031 exchange inside the fund. The fund has about 15,000 units in it. So we're buying and selling in there. That's not something that you have to worry about. And then of course, cost segregation and depreciation are big parts of that. But I wanted to highlight something that if you're going to do a deal by deal and invest in syndications, there's some issues with that. And, again, there's a mistake in investing. I probably made it. But so you do 5 or 10 of these things and then, hey, cool, I did a deal. I'm in this deal. And then all of a sudden, your life gets busy over here. And then these deals start to sell. And then you go, holy smokes, I've got to go find another deal. And I only have a certain window to 1031 exchange. And then, you kind of rush into things, and, you can do bad deals or whatnot. And then if you're a student of diversification and modern portfolio theory, you should, if you're going to buy stocks, for example, you're going to be a stock picker, you should own at least 30 stocks to be statistically diversified, at least 30. The same if you're doing syndications, you should do 30 syndications. And by the way, not with all the same operator, because that's like owning one stock. Okay. So they should be 30 different operators. So syndications is really tough. Funds are a nice way to diversify for obvious reasons, but hopefully that touches on Chad's question.
Yeah, no, thank you very much. And you guys, the next session is going to be about real estate and a couple of operators out there. So you'll be able to ask more question about, obviously depreciation is a big tax advantage, and we still have bonus depreciation of 80% still this year. So things to take advantage of, just market conditions are changing fast, and we'll discuss all that after. I just want to give, before I let Rob and Bo close, I just want to give some other alternatives. So for people out there, besides these two funds that we discussed, you have other options, right? Like, so first, for your cash management, put it in a money market fund. Find a Vanguard that has a low expense ratio, because you could have two money market funds, but one takes 60 basis points, the other one takes 10 or less. So the Vanguard 10, I don't get anything from Vanguard, but whatever. It's one of the cheapest, expense ratio out there. You have daily liquidity for that stuff, so you can sell it the next day if you want and get your money, but at least you're compounding 5% for the year. Build a ladder portfolio with your investment advisor if you want. A little bit of high yield, a little bit of EM debt, which Brazil's still at 12%, and the inflation collapsed to 4%. That's a lot of real yields in there that you can take advantage of. So build a diversified portfolio of bonds. You can have alternative assets the same way that you have those hard lending funds. You have what they call interval funds that will get you exposure to things that you've never thought about: litigation, asset-backed lending in for machinery or boats or whatnot, royalties for music, or so you have funds that are diversified into all these things, so you're not like very concentrated, but still get a decent 9 to 14% as well. Obviously choose them right, spend some time on the due diligence for these things, and then obviously the diversified fund that Bo and Rob manage. And again, you saw the importance of loan to value, loan to cost, and the underlying that they're investing in, and the niche that they create for yourself, because there's nobody in the world that can recreate what Rob has done. And so if you have more questions, please reach out to them directly as well, or reach out to me and I'll make some intro. Rob, I'm gonna give you the first to last out, and then Bo
Sure.
will
So we are a mortgage REIT, and to get that qualified REIT dividend tax advantage as well. But I wanted to just come back and bring this back to GoBundance. One of the things that I try to do with my time is to help people lose less money or make more money, because we've have the benefit of doing thousands and thousands of transactions. And so if somebody is in a sticky situation as a GoBundance member, real estate related, you can shoot me a quick email, and I probably have a solution through there that I can direct you the right way faster than going through an attorney. I can give you the high level bottom line of where this is going to end up, and that's the biggest cost savings that I could possibly save you, is giving you the experience or the path through that's going to minimize that potential loss of a bad situation, or potentially improve a good situation. Generally, people don't reach out to us until something is going wrong, but the level of solutions that we've come up with are so broad that you could never get that level of knowledge base to utilize that. You would have to have done thousands and thousands of transactions. And so I personally try to donate my time back to our group. And that's one of the reasons I joined, is to offer that if I can. And generally I can tell you, look, you're screwed. There's nothing you could do. The time for you to have done it has passed. Or I can say, this is the path that you could go at this point. This is where it'll shake out. This is what you need to be prepared for. And these are the parties that you want to utilize, or the strategy you want to use. So that's what I'd like to end with here, because Bo and I are both members here. We attend a lot of events, and we're both not only members that are participating, but we're trying to give back to our GoBundance community. And that's why I joined. And I think Bo's the same way.
And Rob, this is also for, obviously, people know that Scott is part of GoBundance as well, but yeah, it's for Royal Legal Solutions, which Scott manages as well. So it's
My apologies.
no, it's okay. It's we all try to help each other in this way. So Thank you so much for the time. Bo, you wanna close us?
Yeah, I want to say that there's the two most important moments of your life are the moment you're born and the moment you know why. And you can and you can make a lot of change with your capital. You can invest in things that are making the world better. You can invest in things that are curing cancer. You know, you can choose where you want to allocate capital, and no other time before, we can actually make the world better than we found it by our capital or our time. So these are wonderful events. So, you know, many thanks to Scott, you know, and to Hitcham for putting this together. Your hard work does not go unnoticed. And I don't see Tammy here too. Amazing team. And this is to pour value back into your community is just so darn cool. So bravo to you all.
Thank you so much. And thank you guys. I think that was an amazing session, and you can see the strength of both Bo and Rob and their institutions. So please reach out and learn more. Thank you all, and we're going to start the next session pretty soon.
Awesome.
Thank
Great
you.
to see you, Rob. Good job. Thanks
Take care,
again,
guys.
everybody.
All right.
All right, we have our next presenter and MC for the session. Shane is going to take over. Shane Stokes, for people who don't know him, is a dear friend of mine and astute investor. He's going to share all the goodies, the good, the bad, and the ugly in real estate and what's going on at the moment. And we always try to give you a sense of, you know, a different perspective for how to think about alternative investments and how to choose your operators. We have some great operators that are joining us too, Hemal Badiani, Warren Dressner, and Rob Gallo. All of them are investors, operators. They've literally done it and built successful companies like Rob and Bo. And I think you're in good hand with Shane and for a great discussion here.
Thanks, Hitcham. How's your voice? You've been going pretty hard the last day and a half, huh?
Always.
Yeah, good man. So, and I can only echo what both Bo and Rob said. You guys are doing a great job. Thanks to also Scott Royal Legal Solutions. This is an awesome forum. There's a lot of information. I was able to attend some of the session earlier, so I learned a lot as well. The macroeconomic section. It was touched upon there. An interesting statistic before I introduce these guys and we get into the conversation. I think you can correct me if I'm wrong, but according to BlackRock, endowments invest 52% in alternative investments, pensions 30%, and then the average retail investor less than 5%. Is that correct, Hitcham?
That's exactly right. Yeah, and that's why we're having this session to kind of broaden the mind.
That's quite amazing. So I didn't know that stat. I'll use that. That's fantastic. So as you said, we got three great guests here today who are on screen. You can see them. Hemal Badiani, Warren Dresden, Rob Gallo. These guys are going to introduce themselves and tell you a little bit about their business and a little bit about how they got into commercial real estate. And then I'll start a few questions and we'll get the conversation rolling. You guys can also ask questions of each other, of course. So we'll have a pretty informal, fluid discussion. The group that's on as well, all the attendees, you can post. I'll try and keep up with the chat, although I'm pretty garbage at that, but we'll definitely try and keep up with the Q&A and the chats. So this hour should fly by. We'll have some fun. So firstly, Hemal, so founder and CEO of Sage Equity Development, and then we'll do Warren and we'll do Rob. Hemal, tell us a little bit about yourself and then we'll get into it after that.
Yeah, it's always good to see you, Shane. Can you, hopefully you guys can hear me okay?
Yep.
First of all, thank you, Hisham and Scott. You guys have done an amazing job over the last couple of days, and it's a very informative set of sessions here. So I'm glad to be part of that. But Hemal Badiani, based out of Charlotte, North Carolina, a father of two 7-year-olds, husband married 20 years. That's the important part. And then I came out of a couple of decades of management consulting across 3 continents with Fortune 100 companies and financial services organizations. and then started introspecting and scaling businesses. So this is my fourth stint as a business owner. Our current company, Sage Equity, is a multi-divisional commercial real estate company based out of Charlotte, North Carolina. We've got 13 people in the firm, and we have 4 companies. We do a lot of land development and entitlement, what is known as rezoning and increasing the value of the land. We do a lot of ground up construction. We own apartment communities around the Carolinas that we renovate and add value to. And then we have a foreign funds center for capital stack and immigration and all of that lovely stuff. So those are the 4 companies we operate here.
All right, thank you. And then we'll talk a little bit more about those as we get into it as well. So Warren, over to you.
Sure. Well, thanks for having me as well. So I'm Warren Dresner. I'm based in Miami, Florida. I'm originally from Australia and arrived in the US via some time in the UK. Also married. I got 3 girls, actually. So Amal's right. That's the most important bit. In terms of real estate, I started investing in real estate, single family, and built up a small portfolio of single family. I found it very difficult to manage and to scale. And so my entry into commercial was actually as a passive investor. I invested in a number of syndications in multifamily, mobile home parks, storage, around 2017, 2018. I started getting, I used that, I guess, as an entryway to become more active in multifamily. And now I'm a managing partner and co-founder at Equity Yield Group. We buy institutional quality, large multifamily, later model product, always looking for value add opportunities in and around strong markets in the Southeast. We currently have a portfolio of around $300 million of assets under management.
Nice. All right. Rob, welcome.
Thanks, Shane, and a pleasure to be here. My name is Rob Gallo. I am the director of our investor relations for passiveinvesting.com. Just like Hemal and Warren said, family. Most important, I have 2 children, a boy and a girl. I'm based in Chicago, Illinois. My background is I'm a consultant, recovering consultant, as I like to say, as well. 18 years of successful consulting career. During that time, I've been an active and passive investor for about 10 years. Actually started off as a passive investor with one of our co-founders, Danny Randazzo, at passiveinvesting.com about 10 years ago. And then, actually recently kind of made the switch to say, you know what, this is really the space that I want to be in. So at passiveinvesting.com, we're about 1.4 billion in assets under management. 1.1 of that is multifamily. We also have storage. We have a debt fund that we do that helps kind of our financing arm that focuses on rehabs. And we also have car washes, which is one of our alternative assets that we get into. So thank you. And I'm glad to be here.
Great. Also, we got an amazing coverage here in terms of the asset classes within commercial real estate. But let's start macro. We're going to talk about each of your perspectives really on why commercial real estate versus other asset classes. Being that you've also invested yourselves, you've got quite a rich background, different backgrounds, of course, but it'd be interesting to get your perspective from an investor perspective. Why in this area? Why alternative asset classes? Why commercial real estate? And then we'll get a little bit more specific as to why the specific asset class that you've chosen. So maybe we'll start with you, Rob, this time.
Yeah, I think, it's honestly one of those pieces, and we just came off of our conference and I interviewed about 24 people in terms of asking kind of a very similar question. And I think, for real estate, commercial real estate, you really see a lot of key benefits that you don't necessarily see, let's say, in the stock market. So for example, we're really in here to invest in real estate for capital preservation, cash flows at the same time. And I think the other piece is participating on the equity upside of the real estate and over that time period that you're in there, as well as some of the tax benefits that you really don't see in other asset classes. And so it's a tool in an investment vehicle that really has several more benefits, in my opinion, in terms of an alternative asset class than just kind of typical stocks, bonds, and maybe some other areas. And that's really some of the pieces that when we talk to investors that we kind of push forward, as well as in this time period, right? It's an asset. It's an actual touch and feel asset that actually helps you do some inflation hedging as well. So those are kind of the key pieces that we inform our investors about.
And then we'll also ask specifically in terms of car washes, for example, or in your case, I know you've got a lot of multifamily, but storage as well. So anything there specific to those asset classes that you think are even more prominent in one of those you mentioned?
Yeah, I think, no, that's a great point. I think in reality, the way that we look at it in terms of our asset class is that each one of those asset class has a little bit of a different cycle on it, right? In terms of, multifamily, in terms of what that looks in the seasonality of when, leases come due, and actually when you're full versus, a storage area that has a little bit tendency to not only have a seasonality about it, but also has kind of a recession proof. So when you're in a recession, people are downsizing, right? Where are they going to take their stuff? Well, they put it in storage, right? As well as, depending on what type of storage you're in, could be boat and RV storage, right? So in the winter months, that's where you're getting more action there. And then you're compensating it on the other side when, hopefully it's close to, let's say, a university, as well as, let's say, some type of, lake or, other places. And so you're trying to kind of figure out that mix there. And then on the car wash front, I think it's a very interesting piece that, when people think car wash, oh, that's a luxury good. But in reality, we've actually seen a kind of a very strong stability over COVID and some of these other kind of downturns, that the cash flows in car wash actually stay pretty stable, because in reality, people still want to feel good. They want to be driving around in a car that looks good. And so that's kind of where we see those other alternative asset classes really coming through and actually kind of balancing each other as you look at kind of these different sectors of investments.
Great. Warren, views?
So I agree with a lot of what Rob said about fundamental benefits. There are a lot of benefits: cash flow, appreciation, tax benefits. As an investor, I'm always thinking about both risk and return. Returns get a lot of press, a lot of headlines, but we got to think about the risk as well. And I think with commercial real estate, the risk is really managed really well. As Rob said, we're buying a hard asset. We can see that asset. It's a tangible asset. And even if you go through some swings and roundabouts through the holding period, we've still got that asset that we're owning. And that mitigates the risk. It's an inflation hedge. Another huge benefit, I think, with commercial real estate, well, it's a benefit with all real estate, but particularly with commercial real estate, is the power of leverage. You can lever into a lot of investments, but with real estate, you tend to be able to leverage a little bit more, and that boosts returns. Now, leverage, it's like an elastic band. If you pull too much on that elastic band, it can snap. And so we don't want to take too much leverage. You can introduce risk that way. But if you're sensible about it, you can invest into a lower risk environment and use the power of leverage to actually boost returns as well.
Beautiful.
Your other question about like multifamily, what we invest in and why we love that, it's the fundamental need for housing. We've got a housing shortage of something like 6.5 million homes in the US. And at the rate that the population is growing, we need another 1 or 1.3 million homes every year. So there's a fundamental need for housing. And therefore, I think multifamily is the lowest risk of all the commercial asset classes. All else being equal, you can make good money and good investment decisions in all asset classes. But given that fundamental need for housing, we like multifamily as just a lower risk alternative.
Okay, great. How about you, Hal?
Yeah, I think many of the things are covered, but at the end of the day, if I was 18 as an investor, or 20 years old as an investor, I might want to make some bets in crypto or other places where, maybe I can 10x my returns, etc. Now, with family and the kids and thinking about their college and housing, from a financial services background, what I think about is risk-adjusted return, right? Which is simply, if I make 10 bets, are 9 of them going to preserve my capital and make me some money at the end of the day, versus 5 of them making me 3 times sometimes, or 5 of them failing, right? And so when I look at it from just that lens, there is nothing like real estate, for all the reasons that Rob and Warren mentioned, in terms of a portfolio. Not that that should be the only thing in your portfolio as you diversify, but it should definitely be there for that very reason. Is it'll give you that singles and doubles in terms of returns and appreciation and all that lovely stuff, and it allows you to slowly park your nest egg, build your wealth in a very long period of time with a certain rate of consistency and very low chances of losing your money. So that's why most of my wealth is built around real estate and will stay in real estate, amongst other asset classes in terms of diversification. So from that standpoint, what we are doing in the land and construction side, land is the only asset class where I say, A, you don't make more of it anymore, at least on this planet, right? And then B, think about adding value first, right? In all the other asset classes, you're buying the asset and then renovating it and adding value. What we do is we put up a land piece under contract as a raw piece of land, and contingent on us increasing the density to going to the city and saying, hey, can we build 300 apartments here? And only when the city approves, that's when we actually buy it at the price of the raw land. So we already increased the value. We can sell it next day for 5 to 10 times the money before we've bought it. So that's a wonderful risk-adjusted return for our investors on the land side. And when most of those pieces of land, we sell it off, but the juiciest parcels we keep for ourselves, because Charlotte, 23 days of inventory, 250 people are moving every day. So the Charlotte MSA, again, from a macroeconomic standpoint, for the next 10 years, even compared to many other metro areas, is just very tight in terms of inventory and the migration patterns. And so we want to be able to solve that housing prices by providing, apartment communities, townhomes, etc. And when you already have bought something very cheap, it allows us to have that extra contingency measure or risk adjustment measure as we go into the construction phase. And then strategic relations with banks here, the vendors here, all that. We've built the credibility with the city officials, all the risk factors that one would think with a ground-up construction project. That several years of working with folks here has allowed us that credibility to do it in a much more smoother manner. So that's why our main focus right now is land and construction, less on buying existing assets where the cost of borrowing is super high.
Interesting comments from the other panelists on that point. It's interesting on risk-adjusted returns, and also your point about maximizing the value up front of the land, the starting point being the land.
No, I think, Hemel has a really, really good point, right? And I think, it'd be interesting to hear too, in his opinion, there's been a lot of reports that, in development wise for a lot of either class A's that we're seeing that, hey, there's going to be some delivery in the next, basically 12 months, maybe even 18 months. But then after that, because of what the interest rates are looking at, there's not a lot of shovels that are projected to be in the ground right after that. And I think we're going to start to see a cliff, right? And I think that in itself is an opportunity. So Hemel, I don't know what your opinion is on that, but it's kind of one of those pieces that's kind of a little bit of buzz in our arena.
Yeah, absolutely. You're spot on, Rob, there. We actually sat with one of our national developers that buy land from us. And I think in March of 22, when we sat down with them, they were like, hey, we're going to buy 17,000 lots in Charlotte itself. So 17,000, just one developer, national developer, building in Charlotte. And by September of 22, they were like, we're doing 0, all pencils down. this is too high of a cost. We're going to wait till 2023. So if you think about construction, it takes so much time, maybe 1 to 2 years sometimes, to get through the permitting process with the city officials. And then you have a piece of land that's now ready for development, and then it takes maybe a couple of years to get that developed. There has to be a really healthy pipeline. And if you don't see that, the situation of housing affordability is going to be exacerbated in places where housing is really needed, or apartments are really needed from a renter's perspective, and they're not being delivered at a consistent pace that outweighs the actual need from a national level perspective. So we're seeing that in the Carolinas all around, and I'm sure other pockets in Florida and Texas, et cetera, are seeing that as well.
Interesting what that will do in terms of placing pressure also on the Fed, or what's the status of the interest rates based on that going forward. There's a lot of money on the sidelines, right? And there's a lot of people that are nervous, just like the conversation happened before us here, as to what should you do to limit your risk. And that was one of my questions, was when you think of risk adjusted returns in the current climate, you've just given a good example. How would you think of it from an investor outside of just your area of Charlotte, but across their portfolio? How would you guys think about that?
Yeah, go ahead, Warren. Your turn first.
Well, I can't speak specifically about Charlotte, but look, it's all about risk and return and risk adjusted returns. I think the risk profile that we're coming into for the next couple of years is very different to the risk profile that we faced 2 years before. There were a number of deals that I invested in as a passive investor in the last 3 or 4 years where I made money, but really only because the market was going up. Everyone made money. And I think that's going to be a different environment going forward. So we need to think very carefully about the risk profile of any investment going forward. You mentioned interest rates. The cost of capital is much higher today than it was 12 months ago. And that means even if we're going to buy the exact same asset that we were looking at last year, the price that we're willing to pay for that asset is much lower. So every single decision that we're making needs to be around how can we generate returns, but not increase the risk that we're taking on. And so I think similar to Hamel, all of our decisions are based on risk-adjusted returns with everything that we're doing.
And have you seen much of that price realization yet in your area, Warren?
We've seen some of it, but probably not enough.
Yeah.
There are multiple layers to it. I think interest rates have gone up, so the cost of borrowing has gone up. We're also seeing the impacts of inflation now. So expenses are starting to increase across the board, but in a very big way on taxes and insurance. So I think some sellers have recognized the need to drop their prices if they want to sell their property. But I think we're going to see some further reductions as well, because they haven't quite fallen enough, at least for us, to be willing to take on another investment.
Right. Rob, any thoughts on that?
Well, again, I'll say I'm not a financial planner. I'm not a professional, but kind of one of the things that we like to look at and tell our investors is, any investment that you're looking at, make sure you're doing your due diligence, right? I think it's got to be even more. They need to ask more questions, right? They need to be asking, okay, if you're buying an asset and it's been operating, I'd like to see, the T12 from the previous 12 months of how that's working. And then tell me how then you're going to meet some of these projections and the cash flows, right, moving forward. I think one other piece that we do, like from an underwriting perspective, we have done about 65 plus multifamily underwritings this year. We've not inked one. And I think one of the key pieces that we still want to make sure that we have our fundamentals in place, so that when we come to our investors that, yep, this makes sense. But one of the other pieces that not only is it that the financing is more expensive right now, but in reality, we won't necessarily see the full extent of what that current interest rate is going to do to everything of what could be considered part of the multifamily, because now everything along that supply chain is going to be a little bit more expensive, not necessarily just the financing. So I want to make sure that people, as an investor, make sure you understand that and ask those questions about, okay, well, now things are more expensive. Do you anticipate any of this remodeling or these renovations to be more expensive, and maybe some of those materials? So making sure that they're asking those types of questions. And then to the operator's perspective, are they testing those different boundaries, right? Maybe you're not going to really operate, hopefully, at the top of every single one of those segments. But are you testing and doing those risk tests to make sure that, yes, you can still operate as a business and still be profitable in the end?
So simply put, in terms of the expense ratio, in terms of total expenses, not just insurance and tax, but taking and maybe even a harder look at percentage growth of expenses year on year. Is that the way you think of it, right?
Yep, exactly.
Hemel, thoughts on that point?
Yeah, I mean, Warren and Rob have covered great points. I would say two things, right? One, as an investor, really understanding the market cycle in general, whether it's real estate or otherwise, is a big awareness and helps you understand where your money is going to be parked, right? So in short, whatever worked for 2015 to 21, that time has passed.
Yeah.
Right? That's not going to work anymore. Anything that you bought in that time period, if you did okay or didn't do even too much, you could have passed that hot potato over to the next person who wanted to buy it, whether it's stock or real estate, and you would have made a ton of money. And you would have almost a false sense of, hey, I'm good at this. And that's no longer the case, right? The cost of borrowing is high. The prices are still not as down as Rob mentioned. We under several of the deals, we haven't bought a single multifamily this year on our side as well, even though that was the largest set of purchases in 21 and 22 for us. But we see what's on the tea leaves. So that's one point, understanding when the Fed's going to tighten, what it looks like when they release a lot of money, which they did in 21 to 22. Now stock prices are high. Would they come down again, or can they double again, right? That's what you need to understand as an investor. And the second thing is, really ask those hard questions on the points of failure for a project, right? Where are you securing the points? Where are you stress testing? At what point, whether this real estate deal or any of these projects would go break even or negative, and what are you doing to mitigate that, right? Because at the end of the day, it's the cost of capital, the timeline, or the sales. Those three levers are what you could get delayed in your business plan. You could have more cost of capital, whether it's through renovations or interest rates or any of the things that you're doing, payroll, labor shortages, maintenance costs came high, something broke, whatever the case may be, or your sales price would change because of the macroeconomic environment or your property's performance. And those three levers you really need to understand. So for example, in the construction world, typically we used to do cost plus contracts, which is, we go to a general contractor and say, hey, we want to build a $10 million building. You charge us whatever is for labor and material, but you charge 5% or 8% on top of that as the fee for your management. Now we've changed over the last several projects, we've changed to what is known as a GMP, or general maximum price contract, which is they have a fixed price that says at the maximum, I will charge you $10 million to build this project, but any savings that I can eke out for materials and labor, 50% of those savings would go to your pocket, 50% would go to our pocket. So they have a high incentive to save because they can earn a lot of money that way in addition to their fees. But then from a bank perspective and our valuation perspective of underwriting, we know that a worst come scenario, we're going to build this building for $10 million. So those are the tweaks you have to make as an operator or developer to really mitigate some of those risk factors and really stress out the deal and points of failure, because those can be more now in this environment than they used to be before.
Perfect. Let's focus on each of those three. That's a really good way to segment it. So cost of capital, delays in timeline or hold period, and then ultimately, exit cap or sales price, whichever way you want to look at it. So maybe Warren, what do you think about, the cost of capital, how to mitigate that risk as a sponsor going into deals? And I'm quite interested in your perspective, Rob, on 65. underwritten deals that you haven't inked one of those yet. So it's interesting how even the team that's working on that probably gets commission based on acquisitions is having a tough time as well in the organization because nothing's getting past management. Right. But Warren, let's start with you on that cost of capital, or either one of those three you can touch on.
I could talk about the debt environment in general. So if the cost of capital is going up, simply put, an input cost is going up, which means we cannot pay as much for an asset as we could in the past. So the easiest way to mitigate that is to pay a lower price for an asset that we buy. I think it's a little broader than that, though. I think we're going into choppy waters. I mean, we're talking, it all sounds very negative at the moment because we're focusing on the risks. We're actually cautiously optimistic. I think we've got to be careful because we're in a transition state at the moment, but ultimately there are going to be opportunities. So we're excited about that, and we've just got to find those opportunities. But we are going into choppy waters. There's potentially a recession, and we're going to see unemployment, and we're not going to be able to push rent increases as much as we may have in the past. Given that uncertainty, I think we need to take a different strategy with our debt. I think we need to be more conservative. So yes, the cost of capital is going up, but we probably want to take less leverage than we did in the past. For the last 18 months, we've only used fixed rate debt. So there's been so much uncertainty around interest rate movement that we've really wanted to take interest rate risk off the table. So that's another way that we've mitigated it, just focus on fixed rate debt. Ultimately, though, we do need debt. It's like a necessary evil in this business. So unfortunately, if the cost of it's going up, we need to lower our prices that we're willing to pay for deals.
Yeah, I love the way you simplify things. That's perfect. How about you, Rob? Thoughts on any of those three: cost of capital, time period, sales price, exit cap?
Yeah, I think kind of to what Warren addressed, obviously, that cost of capital is going up with the interest rates. It's one of those pieces that when we're looking at our underwriting, we want to make sure that we're even if we have a good relationship with a bank or several banks, we want to make sure that we're stress testing because, we have a mixture of fixed. And if we do have a variable rate, we are, pricing in buying that a rate cap, right? Because again, that helps mitigate that, you buy it, right? The spread is going to be probably anywhere from like 2%. Let's say if you're buying it, SOFR is right now around 5%. So the spread could reach up to 7% on that rate cap. And so we're really making sure that that's part of the underwriting piece. But I will say the other piece is, and I think a question came in there too on the chat, is you have to have great relationships with either these regional banks or the community banks that they know you as an operator and you have a good track record with them, because it's very rare, I think, just to come into a market that you don't know and start working with banks that you've just met in this type of a market cycle to then say, oh yeah, we're going to trust each other automatically. And then, here's obviously some credit to get on that loan. So it's about making sure that you're curating those connections and that you really have a good track record with the banks that you're working with.
Great. So general maximum price and Hemel's position, fixed rates or rate caps from Warren and from Rob. And then, as you say, the relationship with the banks makes a big difference too. So who you can trust.
Yeah. I would add, I'm having more lunches with board members of banks, regional banks, than I'm having with investors right now. And the reason is, even with the best relationships right now, your leverage used to be 70-80%. If you think about, weighted average cost of capital, what you're borrowing and what your equity looks like, the leverage point is now 60-70%, 60 to 65%, especially in the construction world. So we're looking at other creative ways to ensure, because if you're borrowing 60%, now you're getting equity. If you're just getting common equity or from investors at 40%, your margins and your returns are smaller on the investment side. So we're looking at creative things like the public-private partnerships and grants for construction projects, which is, free money depending on where you're building. And again, it helps to know our sub-markets and paths of progress and economic development plans. And we also bought this other the foreign funds company that allows us to come in with cheap capital. So the amount of capital dollars we need from our investors is very small compared to what typical firms are looking at, usually in the 10-15% range versus 30 to 40% range. And that allows us to provide an outsized returns to our investors still in this environment by structuring it differently, right? So your cost of capital, if 2 or 3 stacks are at lower cost, then the fourth stack can be at the higher cost.
Yeah.
So that's another point I wanted to add.
Yeah. Sorry,
Yeah.
Hamal. I just want to make one point on there too, because the LTVs that we're talking about on some of these deals that we're looking at, we're getting that pressure that it's coming down, and they want to see more. The banks want to see more of, the equity side in the mix. And so we're currently kind of balancing that. And like, okay, we definitely are probably raising a little bit more from our investors to make sure that that's part of the equity. But again, that's kind of going against the recession way of saying, well, people are being told, keep some dry powder, right? Keep some of that cash. And so that's kind of that, kind of one of those things that we're facing in the market today. And we'll continue to face as we continue to move forward.
Yep. Agreed.
All right, there's a couple of questions coming in. I just wanted to quickly jump in with one. Actually, no, we'll ask these first and I'll jump in with mine after. So one was potentially a credit crunch for real estate borrowers. How might another highly publicized bank failure impact credit availability to real estate? Who wants to hit that one?
So, I mean, I agree with the regional banks and all that. There's a lot of value in that. Our strategy, though, we don't actually use those banks. We tend to borrow from Freddie Mac and Fannie Mae. So we're going to the agencies, and they have a mandate to put money out. So right now, I don't see a crunch happening in that space because the government wants those entities to lend money so that housing can be built and developed in the country.
Mm-hmm.
I am a little concerned that, like what we saw with SVB and Signature and then First Republic, whatever they were called, First Republic, I think. I think if we saw 1 or 2 more of those collapse, my concern as an investor is maybe we'll get some sort of contagion or fear in the marketplace, and then some of these smaller banks will stop lending or start to pull back loans that are already out. So I'm concerned that would really trouble the commercial real estate space because new deals will not get done. Prices will start to drop. But the other side of that coin is that's going to create opportunity. So as an investor as well, I'd be worried about existing deals, but I think on the other side of that, there's going to be some huge opportunities in the space.
Yeah, well said. Rob, thoughts on that?
Well, I had some personal experience with a few of the banks that you just named, Warren, and I'll just say, coming off of some of those meetings and doing some raises with them outside of this space specifically, I don't want to say I told you so to some people, but some of that credit was pretty freewheeling. And I think from that perspective, you have to have a good understanding of the banks that you're working with, really where they're putting their money, right? How they're actually meeting their internal, forecasts and finances. And that's where I definitely see that relationship coming a little bit better to understand who they are, what they do, and things of that sort. But I don't disagree that obviously on the regional side. First, let me say this. No one has a crystal ball. I think I saw that in there. I mean, look at what the Fed said about transitory inflation. Well, that's not really true, right? At least in my opinion. But, I think it's making sure that you're doing the due diligence across the way. And obviously then, like Warren said, working with the Freddies and the Freddies and Fannie about making sure that, yes, you do ideally, it'd be great to get into those spaces, but then also making sure that you're also checking with some of those regional banks as well.
Right. Good points. And I think, Hitch, did you want to comment on that response to Leah's question as well, you've mentioned here, or do you want me just to read it out?
Yeah, sorry, go ahead, Rob.
No, sorry.
I think sorry, the responses to Hitcham. So Hitcham writes to Leah's question is, it's not great for real estate. A small and medium-sized banks with 60 to 80% of the loans to real estate, and the leverage is also high, meaning ratio of loan to deposit. The small medium banks ratios are close to 80% versus 40% for the large ones. So that was just an add-on to the response. And as we go down, there's another question here from Leah. Oops, difficult to manage this. Hold on. Small relationships banks don't have a crystal ball. If there's upheaval in the system, they might not have much foresight and may get a clampdown order from above without ability to warn their relationship borrowers. Any response to that?
Yeah, I mean, you're spot on. I had a crystal ball. It fell and broke in 2008. So that's how it is. Since then, I'm kind of without it. But yeah, if there are more bank failures, the lending would be tighter, right? So if the Fed is walking a very tight rope in terms of curbing inflation and not breaking the system, and I'm sure it worries them too. And from our vantage point, that's at this stage, in our $160 million portfolio, even for construction projects, we never had to sign a recourse debt before. I have not. But now I'm okay to do that. So we will find creative options. There is HUD lending, there's PACE lending, there's all kinds of in the construction space, not just regional and bigger banks. There are bigger banks, the big four are still lending. There's other construction instruments and lending instruments that we work with good brokers and are developing strategic relationships, knowing that these kinds of scenarios could come up with. And sometimes it could slow our pace down. By the end of the day, the macroeconomic factor of housing shortages, the fact that if we are slowing down, everybody else is slowing down too, in terms of construction and building, would also exacerbate the situation of housing. Whenever lending becomes available again, then we'll be going full pace again as well. So you just have to time it, right? And that's the beauty of the construction world, is unlike buying an existing asset, which you have to buy in 60 days, you have a couple of years to slow down or speed up and do certain things to help through this challenging environment that one might face in the near future.
Okay. All right. Okay, let me ask a question here about expectations. There was a lot here about what to expect when you're acquiring properties and price realization maybe not being there yet. What about investors? Do you think investors have adjusted their expectations in terms of returns, whether that be overall IRR returns or equity multiple or whatever return that they particularly put their thumb on? Have you seen that yet? I have my own questions on whether people have actually accepted the new reality, but I would love to get your perspective. Do you want to start?
I would say some have, some haven't, right? At the end of the day, whoever is looking at and made money a couple of times in that 20-25% range IRR, and they're looking at only one metric, how much annualized return I had, they can get caught up into that expectations and don't see every deal as a risk-adjusted return. What could it look like? But some conversations that we've had are fruitful because they're like, yeah, we want to invest with you because we know that we're not going to lose money, and you're doing certain things to pivot in this market that other people are not, and we like that. And so we're fine with whatever returns you're projecting versus, hey, I need that 20% return or I'm going to the next guy. So it's a mixed world we've seen out there, and everybody has their own prerogative to invest with whoever they believe would have their best interest in mind. And so that's the environment we are in.
Yeah. Okay. I think that's spot on. What about you, Warren? Have you seen anything like that?
It's a little too early to say that investors have lowered their return hurdles. Our deals have always been on the lower side. We've never had deals that projected 20% because our strategy is to try and find a lower risk alternative with lower risk adjusted returns. So we were always targeting 14 to 16% IRR. We were never at that high end. One thing I do think I've noticed is that a lot of deals at the moment are not paying distributions. Sponsors pause distributions, and so investors are frustrated. And one thing I have noticed is that investors, I think, are looking for a better quality sponsor and more certainty around the payments that they're going to get in future. So it's not really a question about, is it a 14 or is it a 19? It's more a question about, can I expect to receive these monthly or quarterly distributions that you're projecting? Because I don't want to be in another situation where I was projected these amounts, but now I'm sitting with nothing.
Yeah,
So I
right.
do get a sense that investors have kind of woken up to that fact and are now trying to move more towards those sponsors that they find more reliable and more trustworthy.
Good. Nice point. How about you, Rob?
Yeah, I think, for investors that have been with us for a long time, obviously, I think they're a little more sophisticated, and we only deal obviously with accredited investors, but really it's the sophistication of whether or not someone's been through this type of cycle in the market, right?
Mhm.
And, that's one of the key pieces that we try to educate people on, even at the beginning, even in the good times, right? These aren't guarantees. We're not backed by FDIC, right? I mean, that's one of those pieces. In fact, I had a conversation with an investor yesterday about I'm getting 5% in the savings bond, and yet you have one of the properties on pause, and completely understand, right? And frustration. In fact, I'm in that deal, and I'm not happy about it, right? But we are operating that business the best, of the ability that it can. And we have to be flexible, right? And making sure that even in the beginning, and I think there was another question in there about reserves, if your operator doesn't have reserves at the start of the deal, right? Not only to make sure that it's covering the capital improvements or what they need to do in order to get up to where those projections are, but also for, an overage, 10% overage or what have you, they're not really that good of an operator, right? And so it's about making sure that the investors are aware of that and then educating them on making sure that they're asking that type of question so that, hey, eyes wide open about what you're coming into as we get into this.
Nice. And when you look at passiveinvestment.com and you think about the different assets that you're selling or the different funds, how is it changing for you in your role in terms of what you would promote to your investors? So maybe just give us a little overview of the type of things that are available, and then the average investor, the way that they're responding to those promotions.
Yeah, no, great question. So, I mean, typically, as I explained before, I mean, we're about 1.1 billion in multifamily, and that's really kind of where we cut our teeth and have experience and have grown the portfolio. But it's one of those pieces that when we actually take a step back, certain investors want a little different something, right? So obviously, multifamily and more traditional real estate, there's the depreciation piece, but you're in there for a longer hold in terms of your capital. Well, we have a debt fund that actually allows, up to 100,000 at 6% monthly. Above that, it's 8%, right? And so that's going to be more of a monthly distribution that we're running out of that. You don't get the same, benefits that you do in a real estate, like depreciation and some of those other tax pieces. But because you have a 90-day redemption on that, you can kind of hold your money there, earn that interest, and come out. And then specifically in the car washes, right? It's an alternative asset class that not a lot of people are very familiar with, right? But after we did our 18 months of due diligence on that asset class, spoke to consultants, did underwriting a couple times, and started operating the first one, then we started to really say, okay, yes, we're bringing this to our investors. There's more cash flow up front in these express car wash spaces. Obviously, there's some other risks that we have to make sure, because how you operate them, you have to have trust in that. But then it's about saying, okay, we vertically integrate all of our car washes to actually build into our own brand, right? That we understand the machines, that we understand what chain should be under there, to make sure that, yes, that alternative asset class, even though it's new and a little bit different makeup than some of those other pieces, you're still getting that benefits with a different kind of cash on cash expectation.
Interesting. Okay. And then you said, have you started to pivot from where you were traditionally in multifamily towards car washes and debt fund, or is it just an add-on to the existing portfolio?
It's an add-on to the existing portfolio. I will say one of the areas that we saw as kind of before COVID was hotels. And we do own and operate one hotel. It's in a great location, and we have a great deal with, actually, it's a Holiday Inn Express. We have a great deal with IHG as well, in terms of we're remodeling one piece and then they're going to kick in another $1.5 million when we're done. But it's one of those pieces that, now that we're into it and we do have experience to manage about it, it's something that maybe it's too intensive, right? And so we've kind of put a pause on that type of a asset class, just to say, okay, let's make sure we get this first one full cycle, take those lessons learned, and make sure that if we do continue in that type of an asset class, that we have a even better and streamlined structure in place to continue to support if we're going to grow in those places.
Okay, awesome. Warren, how about you? We're going to just go through each of you in terms of how are you presenting to your investor group? What type of deals are you looking to, if you have something available that you're looking to present? Just, your thoughts on that.
We don't have anything at the moment. We're actively out there underwriting, looking at deals. We try to stay in our lane. We're not a big enough firm really to start looking at some other asset classes. So we're very firmly in the multifamily space. We do look at some conversion deals. So we've looked at some hotel to multi conversions. There's one we're looking at closely now, which is an aged care facility conversion to multifamily. So that's one way of trying to be creative and find value in this market.
Right.
But otherwise, we're just sticking to what we know, which is these newer products. So 1990, 2000 built and newer, value add multifamily in and around strong markets, mainly in Florida and Texas. We also look a little bit in the Carolinas. And we kind of just stick to what we know and trust. So I don't know if we'll find another deal in the next few weeks or in the next few months, but I know that there will be some great opportunities coming in the next few months or the next year or so. So we're just keeping our head down and hoping to find something great that we can present to investors.
Yeah, and keep operating the ones that you have, right?
Absolutely. Yeah, should have said that. Should have started with that. I mean, that's the most important. And that is taking up a lot of time at the moment because it's a more difficult environment than it was previously.
Yeah, you got a good one out there. All right. Well, how about you, Himmel? Tell us a little bit about, you've got some exciting stuff going on.
Yeah. Our main conversations with folks are, hey, the next 12, 24 months macroeconomic environment is going to be volatile. We have higher velocity investments instead of putting your money in for 5 years lock with an existing multifamily. Our typical land and construction deals are 18 months exit, right? So instead of parking your money at 4%, now you're earning 18 to 22%, sometimes more, because land, we've already added the value on the land side. The construction projects are built to sell. We already have a forward sale scenario or pre-sales going on the things we are building. Great locations, near downtown Charlotte or other in the Charlotte MSA that we're putting in. So why keep your money in the bank when you have, in the next year you can cash a check and earn decent returns, and then figure out what next is coming up, because in 18 months, who knows where things would be from a Fed perspective and the rates perspective, or wars or other crazy things that we have zero control on. And so you want to have semi access to liquidity, but also not go negative in terms of earning it at 4% when inflation is at 6-7%. So that's the scenario that our investors have been happy with, and rather than locking their money in for several years, they're looking at some of these shorter term deals that we are either building and selling, or buying the land and selling it off.
All right, that's an interesting one. So you said 18. You say 18 months and 18%.
Yeah, 18 to 24% is one of our construction project right now that we have a few folks on this call that have invested in, and then our land projects are typically higher than that. One of them, I think we projected 27%, but we already have a contract in, so that might be around 45%. Again, past performance is no way indication of that could happen again, but that one is a good home run deal for us. We are excited for it.
Excellent. Okay, and then I'd like to hear more about you said your fourth business you bought as foreign funds, so it'd be good to talk about that.
Yeah.
Okay, so guys, we've talked a lot macro perspective, gone into some of the specific commercial real estate asset classes you're in. I really like the way we broke it down: cost of capital, time delays, sales price. Great discussions all around. Any questions you guys particularly wanted to ask? And by the way, there has been a question in the chat. How do people get in touch with you here? So either you can just, I think Hitcham is the best to just put it in the chat, or how do you want to do that?
Yeah, you guys can put your emails in the chat, and obviously anything can either come back to me, info@wealthflowpartners.com, or Tammy and the Vault can also get people there. But please feel free to add your email in there. And yeah, maybe Shane, you can tell us also about your firm. I mean, obviously you're working for we talked just before this call about like why niches are important, and we start seeing it here, right? Like Warren is an ultra specialist on multifamily. Hemal has a great sense of how to capture the market turns by diversifying into land, construction, multifamily. Rob obviously also has a great diversification into even like small businesses that we are going to talk about for a full session at 3 o'clock this afternoon. And one niche that we like because it's also has less supply is mobile homes and self-storage is an interesting one that you guys are a specialist in. Shane, you wanna share a little bit, and I'll post like the book from his CEO.
Oh, thanks, man. Look at you. Look at
That
you.
is also a great read.
I certainly by no means want to steal any thunder from these guys. Done a great job in outlining their business. But yeah, I mean, I work Patriot Holdings, which, as you say, specializes in mobile home parks, self-storage. I think to Rob's point, very inflation resistant and good and bad times or good times. So I'll put my details in there as well in terms of my address there. But effectively, we look at the same sort of things: IRR, high depreciation, because you can get that pretty nicely with the work that you can do, and the first year bonus depreciation that we offer. So you can get some really good for every dollar invested, $1 back on depreciation for those looking for capital gains, trying to alleviate that pain in terms of
just for those on the call who listened yesterday to the tax strategy, someone mentioned the 200% depreciation. So some of us did that through Shane's platform last year.
Yeah, that's right. So depending on which fund, you can get, in fact, up to 200% of your invested amount. And that's mainly because, you're buying basically self-storage, pretty simple. You're buying land, you're putting down paving, you're putting some prefabricated steel on top, and then based on the tax laws, depending on the ways you change the configuration of the unit size, you can take a large proportion of that work done as a cost segregation for your bonus depreciation in the first year. So while we still got the good 100% last year, 80% this year, we still can offer pretty aggressive bonus depreciation. So that looks good on the K1s. And then, yeah, we're always looking for opportunities to buy assets that haven't got too much work to be done, value add, but they can generate cash flow immediately. So we've got a cash flow generating fund, and then a development fund more in line with what Hemal was talking about, which doesn't have cash flow up front, but it has over time an appreciation of value. So yeah, feel free to reach out to me. I put my email address in the chat as well. So I'll send it through now. But thanks, Hitchin. Appreciate the time. Letting us all have a chat, and I enjoyed meeting you guys or speaking with you guys. Rob, I think first time we've chatted before.
Yeah.
Thank you
very much.
Thank you, Shane. That was an amazing conversation and really appreciate it. And thanks, Warren and Rob, for sharing the stage.
Yeah, you too. And it's always, I love these types of forums because we can all learn from each other.
Yep.
The more we talk about and share experiences, the more we all get better.
Yeah, and that's one of the pillar of what we're trying to do also here is, just gathering a community of people who kind of support each other and help each other. And so, yeah. So just for what's happening next in the afternoon. So we're gonna take I see that Eric just joined, but Tammy, are we at 1:30 or are we starting right away with Eric?
I believe we were going to have Eric on from 1 to 1:30 Eastern time. And then at 1:30, we were going to break for 30 minutes until 2 o'clock when we come back for our 2 o'clock panel.
All right, wonderful. So yeah, so next is going to be Eric Cabral.
Thanks, guys.
He's a master pro for podcast branding. And then later in the afternoon, we're going to have another very important subject, which is going to be due diligence on deals. I think if there's one that you can't miss, is probably that one, because it's just so important to do the due diligence, especially in the alternative space where there's less transparency sometimes and less information out there. And surrounding yourself, obviously, by communities like this one is clearly a plus. And finally, we'll just close at 3 p.m. with two amazing guys as well who built very, very strong businesses. One on the franchise side of things, the other one on the small business side of things. And that will like just open up the alternative space that you can tap into that is a little more active than passive, but still, in terms of cash flow, in terms of, and you can invest in some of these as a passive investor as well. And we'll talk about that. So without further ado, it's 1 o'clock. We have Eric with us. He's amazing. If you have listened to his podcast that we will post on the chat, and he's going to take us through a nice journey on how to think about branding, how to, if you have any needs for your companies or anything, you will obviously be able to reach out to him, and he can take you to the next level. So Eric, without further ado, introduce yourself and kick us off.
Hey, brother. Thank you so much, Hisham and Tammy and team, everybody. So blessed to be here, honored to be here on this Friday. I just wanted to check in with everybody, and maybe through the chat or through show of hands or however you want to do it. How many people here consider themselves a personal brand or have a personal brand online, meaning what I like to define it as, and I don't want to spoil it, but it is basically your online reputation. Like you have a digital breadcrumbs that lead to you, is what I call it. Does anybody through the chat say yay or nay, Y or N, yes or no? So a personal brand, and I'm going to talk about really quickly why it's important. And then also for those of you, anybody have a podcast? If you have a podcast, share in the chat or just say, yeah, podcast. Yes, podcast. Or share your link, actually, if you have one here. Everybody here can love and support each other in terms of subscribing to each other's shows and, and supporting and helping each other grow. But yeah. Okay, cool. So that's good. I just want to get a sort of idea and flavor for the room. But if you would allow me to share my screen, I'm gonna share a bit about podcasting, and then also really the importance of personal branding and as it supports anyone who's out there who's considering a podcast or has one, being very intentional with what you put out there in social media in terms of building your reputation online. So I'm going to share my screen if that's okay, and then I'm going to go a little analog, which I love to do. Give me a second here, get the right file up. All right, here we go. Bear with me. We are going to, can you see my screen? I'm going to close this out. Boop. All right. So this is going to be a fire hose of information for you, but the beginning of this here is really about the importance of personal branding and why we all should be considering and thinking about it. And I'm going to go through an exercise on how to create your own, or do it with a clear plan on how to develop and be clear on your message, because that's truly what I do is help people gain clarity in their message so that they can deliver that message with clarity. Because if you're not clear, how can your audience be clear? How do they know what you're about? And I'll talk a bit about that here real quickly. So we're going to discover why it's important to have a personal brand. And then I'm going to share with you some core values of mine personally, especially as we go through the exercise. And I hope those of you who don't have a pencil and paper or pad, I recommend getting one now, because we're going to go through a workshop here together on how to develop your personal brand. And I think Hisham has gone through this exercise with me and asked me to share that here as well. Yeah, awesome. I love it. And then if we have time, we'll talk a little bit about podcasting, but I'm guessing we won't, since we only have about 25 minutes left here. So then the workshop as well. So, and hopefully you have any questions. So quickly about me, Hisham and I know each other through GoBundance. I don't know how many are aware of that, but it's a wonderful mastermind group that we're in, mostly full of real estate investors. So that's what brought me to that group, was being in corporate America for over 20 years in the creative space. So I would build in-house creative agencies within pharma. I did that for many decades. until I realized that I was building wealth for others. I was making companies multi-millions, if not billions of dollars through our sweat and effort. And when I got to the top of the corporate ladder and hit a glass ceiling, I realized and started reading. I took the purple pill in Kiyosaki's book and realized, oh, I need to create legacy wealth. I'm financially illiterate. It was all sorts of things happening to me on my drive to work, where I was angry and frustrated, but inspired to do something about it. And I left the job after many, many years and decided to become a real estate investor, not intentionally building a personal brand. I didn't know what I was doing. All I knew was that I had to be on social. And I did most of that through podcasting. And the podcasts would help me develop relationships. And the relationships eventually became new clients, became partners, helped me to become a general partner in the second oldest winery in the country called Renault. Those opportunities would never have unfolded and been presented to me if I didn't have a podcast and a digital and online reputation, AKA personal brand. So that being said, I want to share this one wonderful quote from Larry Winget, who says, discover your uniqueness. I like to say superpower, and exploit it in the service of others. So discover your uniqueness and exploit it in the service of others. How can you help people? What problem do you solve for your audience and for your potential clients? It built this community. It built opportunities, as I mentioned, for me in the real estate space. And I was able to build my company, On Air Brands, that served this community. Because as you can imagine, a lot of real estate investors are data-driven. They love to spend most of their time in spreadsheets. I'm the opposite, where I'm a creative guy. People would call me a unicorn in these networking events because I was focused on my brand and building a brand and visuals that were really intriguing and inspiring. And people would ask, oh, who did your logo? Who did your website? Who's doing your podcast? And it was all me and my eventually team. And it grew everything. It grew a community and it grew a brand worth paying attention to. And it gave me opportunities to speak on stages and then eventually my company as well. So I also, through the podcast, got an opportunity to meet Gary Vee and then work with Gary. And we continue to work with, I don't know if anyone knows VaynerMedia, but he's like the darling sweetheart of social media marketing. And I got into what they call the Vayner water stream, the Vaynerverse, and work with them. And people like Ashton Kutcher, who does virtual calls like this, and we share ideas. I'm blessed to be known as the podcast guy there. That's how they recognize and utilize our abilities, is we produce their podcast for the Chief Art Officer, Claude Silver, and we often guide them in their other podcasts, such as Building While Flying. We've been on the podcast as well on his show. So a lot of really good things happen as a result of me building a personal brand and a podcast. So, and that's a big mess I've made over time, working with a lot of other individuals that have helped to support and elevate us as well. So when developing a personal brand, what's a cool thing about this, and I'm sure many of you have this already for your business, is set of core values, which eventually those set of core values can lead to your mission statement. And the mission statement for me personally became, I make the world better, one mic at a time. And then eventually I realized that is the company's mission. So I made it the company's mission, which is we make the world better, one mic at a time. And if you have a consistent and simple and clear message that you can put out there to your audience, to social, to your potential clients, to your existing clients, now they understand you at a deeper level and can get behind you on that mission. So I'm always looking for mission-driven entrepreneurs that I can help to get their word out there, help them with clarity and delivering their messages. So we do that one mic at a time, obviously through podcasting, through virtual events like this. I just got back from Orlando and I was speaking on stage there. There's a microphone on stage. So there's many, many wonderful opportunities using that tool as an amplification of my voice and my message so I can find the right people who I can serve and who I can help. All right. So personal brand, what the heck is it? As I mentioned, it's your online reputation. So consider that. What are people saying when you're not in the room? That is your personal brand, a very important part of it. It's also your opportunity to build trust. Building trust while you're asleep happens on social. People are constantly thumbing through their feeds. They're constantly scrolling up and down. Even if they listen to or watch you or do whatever, they see you're active. They see what you do. They see you at properties. They see you at networking events. They see you, and you're always top of mind for when they're ready to work, to engage, to reach out, to learn. Okay, so we have to build trust over time through a podcast. That's a wonderful way for me and my team and my clients, is when we go to a networking event, people already know who we are. So there's a high level of trust at that point with very little effort, consistently every day if you have a team. So why is it important? This stat here is really powerful, and pay attention to how many people gave feedback. Over 1,000 people participated in this. And, it stems from the Gen Zs all the way up to the baby boomers. So I'm going to highlight some of the things that they said. And I'll read it very quickly to you. The future is personal branding, because the upcoming generation, the Gen Zs, the millennials, do not consider personal branding a game of vanity. It's not an ego-driven thing to them. They see it as a normal and critical, essential component of learning and building trust that influences their everyday life. So I speak to a lot of investors, especially who are in the baby boomer category, and they always see putting yourself on social media as an ego play, a narcissistic sort of task. And yes, I'm sure there are many out there that are narcissists. But what it does is, if you truly have a big heart and you really, really want to reach more people and help people, this is the way to do it. This is a wonderful way to do it. And they consider this essential. They expect it of companies that they want to work with. Number two, it's highly profitable, because 67% of Americans are willing to spend more money on a product service of a company who has a personal brand, and they get the core values. They understand what you're about, right? If you're out there talking about your family man or woman, you're faith driven, you have a bigger mission, and you speak about it, you talk about it consistently with clarity, then people will get behind you, because now you're calling to your people and they connect with what you're saying. Therefore, they want to work with you. Number three, it's a trust accelerator. So 82%, which is a ton, of Americans agree that companies are more influential if they're executives. So think about that. Executives, not necessarily the founders or the owners. If you're not the type of person that likes getting on camera and doing this whole thing, well, you probably have a COO, or you probably have a CFO, or somebody on your team at a high executive level that can do that and loves to do it, and maybe can represent, maybe be the face of the brand for you and start talking about what you do and how you help people. 72% of older millennials, these are the people, remember, are making all the financial decisions over the next 20 to 30 years. So why aren't we speaking to them in the way that they expect, which is us, our faces, our voices? That's the fastest way to develop a relationship over time. All right, core values. So we're going to get into the exercise here on how I can help you develop your core values. But I'll pause if anybody has a question as well. But this is the important reasons why we have to be, this is a building block, the first step to building a personal brand. And I feel like if you have a system of beliefs and core values established, that's great. That's wonderful. Let's start talking about that on social media. Or here, we'll talk about how to develop that. It's your compass. These are some of the reasons that I believe core values are critical to building that personal brand up. It helps you make decisions every day. If you're really clear on your mission, you're really clear on your core values, now you can look to those pillars, those values. It's like, oh, is this type of person, oh, this person doesn't align with my core values, so therefore I don't want to work with them. Or there's an opportunity coming and somebody wants to partner with me, maybe their core values don't align with yours. So it helps you make those decisions. So it also gives you the clarity when you make those decisions. Eventually, and the ultimate goal for me personally is finding my purpose and my mission in life. And it helps with that. As I mentioned, direction for life. Okay. think last quote before I want to get into this exercise. I'm glad we have about 15 minutes left so I could share it with you. So living into your core values means that we do more than profess, we do more than talk about them, but we actually practice them. And people will appreciate that if they see you living your values, expressing your values, and sharing it with the world. I highly recommend that you look this up if you don't already have this, but these are a deck of cards. So for anyone who's ever, if you put a Y, a yes or no, or you need to get it, maybe. The One Thing by Gary Keller. Wonderful book. I highly recommend reading it. So his company created this, and I think in partnership with another company here, of Best Self. And it is hundreds and hundreds and hundreds of cards and adjectives that you can use to help you identify what your core values are. Your company's core values, your family's core values. So I recommend buying this in conjunction with the exercise I'm going to share with you and the tool that I'm going to share with you to develop your personal brand. All right. Oh, I lost my screen for a second. Where are we? Oh, did I lose you guys? Okay, cool. So this is an example of my core values. I've created one on the top. Those are my personal core values. Create, be happy, inspire. I'm going to share this with you in the tool that as we go through the exercise. I actually developed one for my family as well, which is great because that actually the acronym spelled out FIGS. So we often say, you know, after our family meetings every Sunday morning, we say, hey, where is a core value that you can share that you lived this past week? What did you honor? And what's an example? Is it family? We say pull from the fig tree, an example. Oh, I have gratitude, Dad, or I have growth. You know, I finished, I found out how to do my backstroke. My daughter's going through swimming lessons this summer. So things like that. And then for my company, we have an internal and an external facing core value set. So these are wonderful. You can build so many things off of what we're doing here and the tools that I'm sharing. Okay. So I think, and I'll share this, I'll come back to this in a minute, and I want to stop sharing and I want to show you, if anybody has questions while I transition to another camera, I do want to change my camera here. Let's see, which one is it? Aha. Aha. You guys can see that. I'll move my keyboard out of the way. We're going analog. And I did learn this from my buddy Jeff Woods at The One Thing. I love when he does this, so I got inspired by him. All right, so if you have a pen and a paper, I'm going to sketch out some things here for you that can help you develop your personal brand. And this will take time. We're not going to do it all overnight here. Let's see. Okay, great. Thank you for those links, guys. I would start off here by putting a circle. We're going to create a Venn diagram here, so to speak. So the first one is it's you. This is going to be the focus on you. And I like to say 3 P's here. We're going to be personal. Okay. And start to make a list of things that describe you. Things that you believe in, things that make you move, things that get you up in the morning. So for me, I'm going to use myself as an example. The first thing that I developed, the first word that really I'm using these cards here, you're going to narrow it down. I mean, it's so overwhelming, but when you put all the cards out on the table that represent you, then you can narrow it down to typically 5 or 6. So these are just some of the ones that helped me to be clear on who I am. And I love to create. And when I create, I'm most happy when I'm in that mode. Right? I'm in flow when I'm creating. So happy became one of my core values. Being inspired. The inspiration helps my creativity. So when I'm inspired, it makes me want to create. It helps me to go do something, take action. So once I'm inspired, I love to inspire others as well. Spreading love. That's what I love to do. I love to share. I love to pour into people. I love to be poured into as well. But that became one of my core values. Anyone who knows me well, maybe Hisham, I love to a fault. I trust everyone. I'm like a golden shepherd. All right. And then confidence. I like to typically stay in my lane and talk about things that I'm really good at, which gives me confidence. And then I can share that confidence and then inspire others to be confident. But these are my core values. So come up with your core values, especially, you know, if you have the deck of cards, and I could share the, oh yeah, you have the link there for the One Thing card deck. Find your core values and place them in this part of the diagram. Now, we're going to get into the second one here, and I hope you're sketching and following along with me as you're probably having lunch. All right. This next one is how others perceive you. I before E, except that's the, I can't press. So others. Okay. How others perceive you. So here's a wonderful exercise that I really recommend you do is you can guess how people perceive you. Like, oh, he or she's trustworthy. He or she, they're always late. or, you know, they know their stuff. They're intelligent, whatever it is, you can make up this stuff on your own. But I highly recommend you text 10 to 12 people that are closest to you from the past, present, future clients, whoever it is that you think and trust their opinion, and ask them this question. 2 questions, actually. Number 1, what do you think are my strengths? You can do this in an email as well, but you can ask them what are my strengths? I'll put this over here on the side. Sorry. Ask them what your strengths are and ask them what your weaknesses are. And a lot of people will be uncomfortable with this, but you can tell them that, hey, I'm going through an exercise to gain more self-awareness, to build my personal brand. And I just wanted to get your opinion. And what you're going to find once you start getting this information back is there's going to be some consistent words, you know, trustworthy, loyal, you know, consistent, whatever it is, you'll see 3 or 4 words that are popping up, and then you can start to populate this. So when I did this exercise, and I try to do this more than once a year, people called me a connector. Like, Eric, you have a huge network and you're always looking to connect people to who can help. You're a podcaster, obviously. That's how people see me when I walk in the room. There's the podcast guy. So think about yours. How do people perceive you? So this is an exercise that's going to be able to help you find these words. I'm a branding guy. You know, he's a real estate guy, things like that. So here's the cool thing. Once you start to get these words in place and you start to gain awareness for who you are and how people perceive you, that eventually becomes questions that they always ask you, right? So they're going to say, hey, Eric, I know you're a podcaster. Can you help me create something? So that becomes the solution, this overlap here. You become the solution because people perceive you a certain way and they ask you questions around what they think of you, what they think, how they perceive you, and then you provide the answers. Now you are the solution. So the next thing, and this is the last circle that we'll have on this diagram here. And this is a big one, meaning it's really heavy. And I don't expect you to, these you can come up with in the next few days, but this one is a little harder. And this one is your pursuit, or AKA your mission. And this typically, when the top 2, you and others, work together, you eventually get to your mission. Eventually you figure out your mission. And that came to me, as I mentioned to you, I make the world better one mic at a time, by doing this, by doing the work. And eventually it got clear to me. So I see we're running out of time here, so I want to quickly finish this up. But for me, some of the words that I use is, in my mission, I want to be a brand champion, not just for us, but for others. I like to be an advocate for others. I want to be a loyalist. I want to partner with others. So there's a bunch of words here that are part of my mission, but as I mentioned, we make the world better one mic at a time became the mission. Here's the cool thing. I'm going to show you what these overlaps do. When you are in alignment with your mission and you share it with others, others get behind you. Others start to support you, and it builds a community, which is really powerful. When you have a network of people that all are like-minded and all have a similar mission, it builds a wonderful community that you can pour into and help. Now this here, when you take how other people perceive you and you align it with your mission, as I mentioned mine multiple times, it can and will be basically your business or maybe a new business. But this overlap here, how people perceive you with the greater thing you want to do in life, creates a larger business for you and helps others. So that being said, I hope, whoa, can you see the whole thing? Sorry. That's the whole thing right there. I have a link that I can share with Hisham, or I can maybe quickly grab it here. I have a video of this entire thing if you want to watch it. And then I have an actual document that isn't scribble like this. It's a PDF that you can fill on your own. You could fill it out. But let me share that link with you. And then I'm going to stop my sharing. Sharing screen. Am I still sharing? No, I'm not sharing. I'm sharing. Got my camera here. I got to switch cameras. Hisham. Boom. All right. I think that was enough. I breezed through very quickly. I know it was a fire hose of information. I apologize. But I hope maybe we have some time for 4 or 5 minutes. Any questions, any ideas, as I look for a link to the drive that I want to share here with you guys.
Yeah, no, thank you very much, Eric. That was amazing. And I know it's a little short, but I think for me it was, to bring a little bit of creativity, because before we're talking a lot about due diligence, a lot about spreadsheet, as you say, pro formas, all kinds of things, and sometimes we forget to, the mindset and how you get to yourself is hugely important. And we're same thing here, trying to build a community of people who care and want to support each other in their investment journey. So that they can have more time freedom to be more creative and actually grow even faster. 10x is easier than 2x in a way. And so appreciate all the nuggets here. Anybody has any question for Eric? And I'm gonna post also your website so people can save that.
Yeah,
And
I'm gonna
then
if I could share something I want to give to your community here is anyone who has a podcast or thinking about one. I have a guide that I've created where all the experience that I've had over the past 4 or 5 years of podcasting, thousands of episodes. I put all that knowledge into this document here, which I'm going to share with you in the chat. You can go there. You could download it. There's even a link to book some time if you wanted to ask more questions or just wanted to get to know each other a bit. I love that stuff.
Look at that gift. Amazing. Thank you, Eric.
Yeah, brother. All right.
Awesome.
Yeah, there we go. So hopefully you guys got some value out of that. I hope I truly added value in some way, and it was a lot of information compressed in time. But I think there's a way to take some action there, and that would be to get that core values. Download the go to the link that I sent you, and you'll be able to see the video again, or download the actual PDF. Actually, I don't think the PDF. I'll put it in there of the diagram that I shared with you. I like to go analog, but I have a digital version of that I could share as well.
Well, thank you for opening that door for us. It only takes opening the door, and then it's a lifetime journey of growth and support. And I like to go back to these things, a couple of times a year, because you get too busy and put your narrow, so it's always good to just keep at it as after a couple of weeks and months.
Yeah, I'm going to open this up. I see a message there. typically all the files are open, but I'll open the whole folder up to you guys so that you can gain access. All right. And then I'll also put the PDF as well. Oh, it is in there. The diagram is in there. All right. Whoa. Okay. But yeah, I'll make that adjustment for anyone who wants to gain access. And let's see. Oh, here we go. Share with everyone with the link. There we go. Okay, guys. So that should be open for you guys. There's the diagram, as I mentioned, of the PDF, and then a video recap if you guys wanted to go through it again or share it with someone else.
Great.
All right. So feel free to reach out to me. That link where you can download the free PDF is there. And if you want to spend some time with me, share some ideas, there's a link to book some time on my calendar as well.
Awesome. Many thanks, Eric. So for the rest of us, we're going to take a quick break after, a couple of long sessions, and we will be back in about half an hour for, as I said, a very important session on deal due diligence. And we'll finish off at 3 p.m. with the small business and franchising. Wonderful, guys. Thank you so much. We'll be back in 30 minutes.
Thanks, guys.
Okay, guys, we're back. Maybe we'll give people another minute and then we'll kickstart.
I wanted to be the brightest guy on the call.
Didn't expect less from you, Bruce. I love it. It's
I
Friday.
have bragging rights.
Summertime. All right, guys. Well, thank you for joining the afternoon session. I think it's one of the most important sessions for any passive investor who is looking to do things right. So due diligence, as we know, especially nowadays, things are not as easy as they were in the past, and we're seeing a lot of deals going bad. And so let's try to learn from three amazing investors that we have this afternoon. We have Bruce Turner, who's a seasoned professional. He spent his career in the manufacturing housing, mobile home parks and whatnot. And he is an astute investor, has more K1s than I can count. And the second one we have on Hans Brox, who's also both an operator and an investor. He has seen a lot of things over the cycles. He has made it a point in a career in being, very resilient and choosing robustness and strong operators. And he's going to share a little bit of his wisdom, the good, the bad, and the ugly as well. And finally, we have Mike Andorfer, who joins us from the great Washington State. And he is a pharmacist by training, and again, a great investor. He's invested in a lot of different asset classes, and a dear friend of mine as well. So you guys, I'll let you make your own little intro, and then we'll kickstart it with some deeper question to help our investor today avoid the mistakes that many of us have made over the years. And hopefully they can learn from that. And if there's something that they should take home this afternoon, it's really this session, I think. So maybe Bruce, because of your shirt, we'll give you the first call.
All right, you got it. All right. I've started out my investing career about 25 years ago. I had an exit from a e-commerce startup that I had founded in a manufacturing company that had kind of global operations, and so as a young guy in my 30s, I had to kind of start learning how to start placing capital. And so at that time, it was kind of a time where it's very antiquated compared to today, where we have all this information available at our fingertips. So then you would go through a financial advisor, and they would kind of show you, select investments, and it'd be like a company like Man Financial, and they'd show you maybe a managed futures program, or you take a look at a gas and oil program, or an absolute hedge fund strategy program. So I got my feet wet kind of the old fashioned way, working with a wealth advisor, and was very hit and miss in some of that. And then as I moved on, later on in my career, I bought and sold a number of e-commerce businesses, and ended up buying a manufactured housing community, and gotten into commercial real estate with direct ownership, and eventually came back to Clayton Homes for another 10 years, and where I managed mobile and modular home operations in Cincinnati, Ohio. And we did, about 100 projects a year in the Cincinnati metro. And finally pulled the trigger and went full time with my passive investing. in the end of 2021. I had already been investing in a lot of syndications starting at about year 2017 or 18, and realized that I couldn't really place all the capital that I needed to part-time, and that's one of the reasons I chose to go full-time. And so that's kind of me in a nutshell. So today I spend my days looking at lots and lots of deals, working with a passive investor group that I've helped assemble, and we kind of pitch in together, do due diligence, and source deals together.
Amazing, thank you. Hans, you want to give us a little bit of your background and in terms of, you know, where you started and how you got into this, and you have a long career now investing in you know, more than, you know, thousands of doors over the years, and worked with some of the greatest operators out there. So
yeah, so my background is basically I'm a CPA, so I was with PricewaterhouseCoopers for probably 9 or 10 years, and then I started buying foreclosed rent homes starting in 2008-2009 period, and so that was when I got my taste of real estate. And at the time I was still working, and then I decided around 2009 or so, or 2010, I can't quite remember, I quit my job and joined up with a guy that was going to help teach me multifamily investing, and I was going to fix his accounting. It's a long story, but got involved with him, got into a deal with him, put the vast majority of my net worth at the time with him in this deal, and he wasn't running it correctly. And I got voted in by the partners, the other LPs, along with one other LP, to take over the deal and kick him out of control and take over asset management of the deal. And so we turned the deal around, hired the management company that we had been begging him to hire for probably over a year. And there's a lot more nuances to the story, so I'm trying to keep it short. But we took over the deal, we turned it around, and we sold it for a decent profit at the time in the submarket. And that's kind of what kicked off my syndication business. And this was 2012, I believe, is when we sold the deal. And that other LP that joined me in managing this deal that had distress is now my business partner. And so we kind of just started our careers that way, working together. We didn't seek each other out, but we figured out we like to work together, and that's how it got started. So we started working together, and then at the same time, he and I were also working with two different multifamily groups. I was third on a totem pole at a boutique firm in Dallas. We started with 700 units, and I think when I left the firm, it was at over 3,000 or 3,500 units or so. So I was asset managing over 3,000 units. I was doing all the acquisitions from beginning to end, underwriting, all that stuff. So I got, firsthand detail of how to buy multifamily on the, from the ground up. And he was kind of doing the same with another partner. And then he and I decided to peel off and kind of work together because we enjoyed working together. And that's how we got to where we are. And we've done tons of multifamily. We've done a lot of pref equity, mobile home parks, self-storage, 3 full cycle self-storage deals with another one that we own now, and some distressed debt. And so we know multifamily really well, but I know multi-tenant real estate really well. And that's where I've cut my teeth and where I kind of concentrate. I'm also a very active LP like Bruce is. In fact, I sometimes wonder whether I spend more time looking at deals to invest in than I do buying my own deals. I get something like 70 to 75K ones a year. I have a tracker to keep up with it. So it's a lot, but my investment philosophy was basically shaped from that very first deal, where I realized that, you have to be able to understand the operating agreement and the PPM and all those things so as not to get taken advantage of. I almost lost my money in that first deal, and luckily we were able to turn it around. If we hadn't been able to take over the deal and kick him out, we would have been in real trouble. So it's kind of shaped me from that day on. And that's how I sit today. So.
No, and that's super interesting. I mean, nothing better than, hard times to learn the hard way in a way, but at the same time, we're going a little bit through, this period right now where some operators are getting in trouble. And so one of the first due diligence thing to do is read your legal documents. And because as Hans did, he managed to kind of replace the operator. And so that will be stated in your operating agreement at PPM, what they call the PPM, how that could happen and how many votes you need, or can he get out? Sometimes you can't. And so all these, fine prints in the legal documents that a lot of the time it's tedious. We don't want to do it. So if you don't want to do it, have a lawyer or have a group of people that you trust look at it and give you some of that. So that's a first nugget in terms of the due diligence that you need to pay attention to. So let's finish with Mike, and I know Mike, he'll give his perspective on the type of investment that he likes. I know he is fond of development, which is one of the hardest one for me to invest in, and so I'll make for some good discussions. Mike, the floor is yours.
Hey, Hitcham, thanks. So yeah, pharmacist by trade, went into that thinking I was going to own my own business, ended up always working for other people, quickly decided to go into the management side of it and spent 27 years doing that. Hospital systems, long-term care, specialty, retail, that kind of thing. At the peak, I had 53 stores doing about 185 million in sales a year. Ended up exiting that about 2.5 years ago. Had been investing some actively and a little passively on the side before that, and then really jumped into the passive side of it. Found that I really enjoyed kind of looking at deals. Wanted to get into things actively, but the more I started to dig in and really try to become more as an active investor, decided that there were smarter people that were further along than me, and I'd do better instead of learning, how to compete with them and become better, to actually just find the best ones. So spend the majority of my time over the last few years, just looking at passive deals and kind of just develop that technique to kind of look into those things. And have real estate professional status. So my wife is still working at W2. So one of the things that currently I'm looking at is trying to figure out how to mitigate taxes by using a combination of a couple of small active projects that I actively manage, and then passive investing to sort of get rid of those taxes.
That's great. I'm going to bounce on that last piece, because that's one of the reasons we like to invest in real estate. Obviously, we're getting depreciation from those assets, and which make for great tax advantages against your either passive income or active income if you are a real estate professional. And maybe, Mike, you can tell us a little more about that for people who are not familiar with the status and how they can become one. Because I know you can take a test, but you don't have to. You can become one if you have enough short-term rentals or things that you manage yourself to claim that with your CPA. But one thing, and I'm curious about like each one of you, how you think about it. Like, I love the tax advantages, but obviously I'm not going to make that the thing that's going to push me, because sometimes the FOMO and just the tax advantage kind of pushes you to invest in a deal. Would you ever invest in a deal where it's just because of the tax advantage?
No. I'll answer quick on that one. Yeah, you can't let the tail wag the dog on that. And I see a lot of new investors, especially those that have been paying 39% or whatever the top rate is. That's all they look for. Is there depreciation? How much depreciation I'm getting? And I think that, yeah, that's nice, but that should be gravy on top of it. I look at deals completely absent of the depreciation first.
I agree with Hans. I mean, have I done it? Yes, but I did it as a young 34-year-old, much older and wiser now. And I'll say the investment worked out. Mission accomplished. I got the tax advantages I was looking for. I did get all my money back, but and that was in a gas and oil fund. And so, but when I actually look at my long-term returns, they weren't anything stellar.
Yeah, and I am making it more of an importance now, but what I'm finding is that I can use that as one of the things. So I find assets that I am interested in and would like to invest in anyhow, and then I use the tax advantage as one of the, things that I use to kind of strain it out, because I'm looking at 100 deals to invest in one. And so I can usually find something that I'm very excited about the asset, I'm very excited about the operator, and it fits my overall profile portfolio that I'm trying to put together, and has a tax advantage too. But I do invest in quite a few things that are not tax advantaged. I think that's one of the things that is part of putting together a portfolio and really thinking of what you want ahead of time. I kind of go to different asset classes and different types of investments based on how I want to balance things out.
Yeah, thank you. So, maybe let's go back to basics and, try to understand, there is, you can look at a couple of due diligence questions that, you can start building over time. And I highly recommend you to do that. And then obviously use your peers to, and your network to help you dig into more details for each operators. But why don't we go back to maybe, the 4 or 5 things that you really look at into the pro forma, the skin in the game, the operator, this team, these type of things. And so let's start with back to Bruce, and then we'll go to the other.
Okay,
ones.
so you're wanting a highlight of some of the big due diligence checkboxes. Is that what you're asking,
Yeah.
Hisham?
Yeah.
Okay, and so first of all, I mean, I want to find an operator that's an absolute expert in that particular space. I don't want to find an operator that is trying to do self-storage, multifamily, mobile home parks, and Class B industrial. I want them to really be highly focused and have a high level of expertise in that particular space. And even better is if they are very local. It's not, this isn't always the way I get lucky enough to invest, but if they're hyper local in that particular geography and manage that asset and can touch that asset daily, then that's even better. But moving on from there, I do want them to have usually significant skin in the game, but because I want them to be risking their capital right along with myself, but that's not always possible. Some of the older tried and true sponsors that are doing a high volume of deals, obviously they have liquidity requirements and can't necessarily invest a high amount in every deal, though many times the team does invest in those deals and get skin in the game that way. I kind of want them to be wealthy, and so that eliminates a lot of sponsors. And the reason I want them to be wealthy, number one, that means they're accomplished, but that number two, that means that they have a high level of resources. And when they have a high level of resources and a high level of character, if the deal for some reason starts to come off the rails, they can kind of get it back on the rails with their personal net worth and resources. And there are a few sponsors that I've seen over the years, they'll step in with their own capital to protect the investors and protect their reputation because they know this is a long-term game. It's not a short-term game. I can keep going on. You want me to keep going on or share the mic a little bit with the other guys?
Yeah, we'll share the mic, but I totally appreciate that. And I agree with you. It's, it's important, being wealthy, but also, having, enough, the connections and whatnot. Because when deals turn bad and the banks come after you, it's, if you're not a large enough operator, it's very, very hard to get out of that hole. So maybe Mike, we'll go to you and then Hans.
Yeah. So Bruce, I agree with everything you said. So yeah, everything Bruce said, I would agree with. There's a few things I kind of look at investing in the whole deal underwriting as more of an art than a science. I know there's a lot of guys that kind of have hard and fast rules. It's got to be this IRR. They have to have this many years experience. I just kind of get a feel for it as the overall thing. So like Bruce, like you said, somebody we were talking to the other day, they're an amazing operator. They're very experienced, billions of dollars under management. They don't hardly invest in their own thing. And it's like, I need to know why. And the why is because the banks require when they're signing on a loan that they're super liquid. So that makes sense to me. And so it's like, I'm not going to, count that against them because it's a plan and it's part of it. Same kind of thing with investing. I usually tend to go with people that are pretty experienced, but at the same time, there's this trade-off when they become more and more experienced and get more of a following, the splits aren't as good. And so I'm looking for those people kind of in the middle where they're, maybe they got 10 deals, 20 deals under their belt, but they're not a national institutional name yet. And you can still get some of the great splits. But that's because I'm growing. I'm still in my growth phase. If I had hit where I wanted to be net worth wise and I wasn't really going to grow, I'm probably going to, as time goes on, lean towards more of those safer bets where I'm not taking, the risk to get an extra, 3 to 4%, with that kind of thing. But yeah, there's a lot of things to look at, but I kind of, you just get a feel for it overall.
Thank you, Mike. Hans, how about you?
Yeah, so I agree with everything the guys said. Obviously, we're just kind of stacking it on here. The number one thing I look for in deals, however, is there a true value add component? In other words, when you're investing in a deal, whether it's a ground up development, you're buying an asset that needs rents increased or has deferred maintenance or has lower occupancy, whatever it may be, there needs to be some way to force equity into the asset. And you want to create that margin of safety, right? So you don't want a deal where you buy it and you're buying it retail. And if there's one drop in the market, the value goes down. You guess who loses their money first? Your equity, right? So if you create a margin of safety by forcing equity into the deal, by increasing rents, decreasing expenses, increasing NOI, all those things, you create a gap. And you force that gap conceptually day one, right? It's not literally day one, but day one, you buy it, you do the things that need to be done, maybe over the first 6 to 8 months or a year and a half. And then if there is a drop in the market, then you've created that equity and my equity is still safe. Yeah, maybe the value that you just created went away, but at least my equity is still there. And so that is the number one thing I look at before anything else is, do I believe truly that there's a value add? And can the sponsor clearly articulate that and not give me a bunch of, jargon and kind of BS about, there's a lot of like language out there in the OMs, especially by brokers, where there's a value add in every deal, but that's not true. And so you have to be able to look at a deal and go, okay, I believe that there really is a value add. I'm going to look at the rent comps. I'm going to look at all the supporting evidence given by the sponsor. And so I'll ask very pointed questions around that if it's not clear to me already. And that kind of segues into my other thing is like when I look at a deal seriously to invest in, I will probably come up with a list of 10 to 30 questions, depending on how complicated the deal is or whatever. And if I don't get transparent, clear answers and they try to either avoid or brush over my questions, it's an immediate red flag to me and I'm out, because there's so many deals out there. I've noticed that the good sponsors happily answer your questions. In fact, I just vetted a deal with a guy that I've already got a bunch of money with. He's a friend. I know him personally. I completely trust him, but I still asked him a bunch of questions and he answered every one of them perfectly, right? And that's what he did the first day he met me. And he's got guys that are investing millions with him. And my first investment with him was $50K. And I had a long list of questions for him and he answered every one of them, talked to me on the phone. So it's that attention to detail and that caring about you as an investor that matters to me, because if they, most sponsors are going to care if they brush you off or don't answer your questions or aren't transparent up front. What are they going to do when, the proverbial shit hits a fan, right? So that's to me is a very good indicator a lot of times. And everything else Bruce and them said, and I've got a bunch more, but
Yeah. The other thing I'd mention with that is the just not looking at it yourself. I know that I can tend to get, fall in love with the deal or something like that. And so as Bruce talked about, we've put together a big group of very sophisticated, smart people. And I don't invest in anything without having a lot of other people look at it. And typically, if you've got 8 people looking at it, 2 or 3 aren't going to like it. And you want to listen to why they don't like it. And it may still be something you want to invest in. But if all 8 of you like it, you need to find somebody that doesn't to sort of point things out, because there's always risks and there's always things that could go wrong, and making sure that you've got somebody sort of taking that other side of it and then trying to listen. Because I know it's easy to fall in love with the deal, especially if you kind of like everything to start with, and then you just start to get that confirmation bias. So multiple people that are as smart or smarter than you looking at it are a good idea too.
That's a great point, Mike. That's why I'm a member of y'all's group. I'm a member of like 2 other masterminds, and so that is extremely helpful. That's a great point.
Yeah, one of the things we have to get out of, when we're doing due diligence, the biggest enemy really up front is ourselves. And because we have all these biases, right? And so I commonly recommend a book called The Little Book of Stupidity, which you can grab on Amazon. I think it's about 10 or 15 bucks. And it goes over all the different types of biases, cognitive biases that we have and we have to fight against, because it's easy to fall in love with something. It's like a shiny object. And so we do need to bounce things off of each other. And I have a number of different investors, including our group, and I will bounce those ideas off of. And Hans, to your point with regards to getting any pushback, I call that friction on a deal. If you get pushback from a sponsor, or they're not giving you really good clarity or dancing around a question, it's an immediate rejection from me, and I'm moving on, because there's plenty of deals. And while we live in a FOMO society, we can't have FOMO when it comes to deals, and we have to move on. And there's a discipline that's involved. I'll also say, touch on, Hans was talking about the details of the asset and the pro forma, and there's got to be a value add component, which is protecting against the downside. And so I love that. I love having a value add component that helps protect against the downside. And one of those things that I look at and kind of hyper focus on is the debt service coverage ratio on a deal that has leverage. I want to make sure that there's ample margin of safety there, that if we go into a recession and occupancy becomes a problem, that our break even is in a safe place.
Yeah,
Bruce, one thing.
I would just add to that. Sorry, Mike. I'll give you the mic in a second. But in the value add, because I think it's important, and it's something that you don't see, or like you need a little bit of experience. But sometimes you don't realize that some of the operators, they actually raise more money for the deal to be able to pay the first few years of coupons, and they tell you, okay, yeah, it's coming from a value add, but at the end of the day, it's just your money recycled to pay you back.
It just dilutes your IRR is what it does. Yeah.
Yes, exactly. But so understanding the value add that is going to be able to pay you those coupons that they're talking about. So if someone comes in on a deal that is going to need time to get to that value add, but the first year is promising you 10% coupon, well, question these things, so that you get a better sense of the operator, the transparency, and everything else.
So what I was going to say, Bruce, I think you bring up a great point as far as people not being willing to move on. And I think the number one thing I see new people making a mistake with is not looking at enough deals, not having enough exposure. And so they feel like, I'm only going to see one or two, so I need to pick, one out of these three or something like that. And there might be something they're uncomfortable with, and they're just not exposed to enough. And so I really think getting part of a group, or putting in the time yourself to start looking at tens and hundreds of deals will help you with that, because then there's always something else, and you can't invest in everything, and it makes it easy to move on, because it's like, okay, I've got to say no to 60 of the next deals I look at, almost, kind of thing. And so you can kind of wait for those fat pitches.
Yeah, and I want to second and third what both you guys have said. I always tell new investors, get rich slow, hit singles and doubles, don't go for home runs, be patient, because you are right. The FOMO is kind of in our culture right now. Be extremely patient. If I look back the last 12 years, and if I was, 10 years ago knew where I was now, hitting these singles and doubles that I've been hitting, I would never imagined I would have gotten to where I am. It snowballs. Like, you don't have to hit a home run. A 12% IRR on a risk-adjusted is a good risk-adjusted rate of return if it's a low risk deal. Don't go for 20% IRR when you have a 15% deal, or even a 13 or 14% deal that's much safer with a stronger operator and a safer deal in a better market with better value add. Don't get pulled in by the IRRs and some of these high multiple promises. You've got to look at the whole picture, and don't try to hit home runs. I think that's very dangerous.
Yeah, I think exactly what you're saying, Hans, agree 100%. If you protect the downside and you have a good business plan with a good operator in a good market, then you just let the upside take care of itself. And that way you're literally following Warren Buffett's rule, number one, don't lose money. And so I think that's the most important rule. Don't lose money.
Yeah, because if you lose 50% of your principal, you have to make 100% return to get just back to even. Remember that. And it's hard to do.
One of the things that helped me kind of against myself almost from making quick decisions that maybe weren't in my best interest was the amount of money that I wanted to kind of put into the alternative investment space, put it into things that I could get back out. There are some good options out there that are debt funds or things like that are backed by real estate and are run by good operators, where you have 60, 90-day liquidity, and you can kind of take some of that stuff and set it aside, or other things that maybe give you annual liquidity, and come up with your plan. So it's not, the worst thing to do is have a bunch of money just burning a hole in your pocket. You want to get this stuff working for you, and then still be able to have access to it while you learn and sort of slowly invest and look at lots of deals. And then you've kind of got something in there. So don't just let something sit in your bank account, would be my advice.
Yeah, and when you're sourcing deals, you don't want to be looking at the deals that somebody stole an email list and start sending to you. You want to delete those immediately. You want to look at deals that are from referrals, current investors that have had a good experience with that operator, have been with them for a number of years or a number of deals. That is your best. That is going to be your best investment, is investing with an operator that comes to you by referral. And then touching back on the due diligence aspect, which is obviously the purpose of the discussion. I mean, when you get those referrals, you still need to check track records, and so you want to request the syndicator provide you a list of deals that they have done in the past, and the return metrics of those deals, and always ask that important question: have you ever lost money?
Yeah,
for an investor.
We talked about it this morning a little bit as well. Like, ask for previous, communication, ask for their monthly, quarterly reports, ask for, whatever they're willing to provide, and the more transparency they give you, the more, comfort you should slowly get. So Bruce, on that note, like, so for example, next week, we're presenting a deal on Post. Like, why did you choose that operator, and like that value add component, that downside that you protect? How do you get to that downside? I mean, with them, there's a specific, tax abatement that makes it really.
Well, Hisham,
So, can you hear me?
Yeah. Well, I mean, we're looking at an operator right now, and it's, I'm going to call them kind of a unicorn company, because they've done over $3 billion in transactions. This is kind of the best of the best, in my opinion. They've done over $3 billion in transactions, over 129 acquisitions. They own over 34,000 units, I believe. They're vertically integrated. They've got a historical IRR, which is quite eye-popping, of like 33% to their LPs. And they've got what I call a strategy with a moat. I specialize usually looking at assets that are like mobile home parks, certain kinds of self-storage, Class B industrial, and workforce housing, because a lot of these assets have a moat around them, meaning there's a limited amount of supply that can come into the market, or it's just a scarcity asset, and competition can never come in to, like, generally speaking, to a mobile home park or a Class B industrial. Well, they have kind of a moated strategy in that they do a tax abatement workforce housing strategy, and they work it out with the Texas Housing Authority, and so when you can remove the tax, the property tax, out of the NOI bolsters by about probably 20%. So expense ratio can drop, from 50s down to 30, and so that is a really well-honed strategy that they do. They rinse and repeat it over and over and over. They would produce an investor, a first-year cash-on-cash return of over 7% per pro forma. And the best part is I know many investors that have invested with them with nothing but good things to say. And another great strategy that they have is, because it is a tax abatement play, they're able to take the land, they sell the land back to the state. And so when they do the depreciation on the asset, that, they can do a first year depreciation of 60 to 70% to the LP. So that's a pretty attractive strategy in my opinion. And that's why I like them. And another reason I like them is because I was able to call my buddy Hans, and Hans is an investor with them, and he was able to talk to me about, you know, the owner, the founder, and he's invested with them a number of times. And again, that goes right back to finding a good company with a referral and doing your due diligence on them that way.
Yeah, and a good point there to all add on this company that Bruce is speaking about. You know, we one of the things that I've invested in a ton of their deals, probably for the last 7-8 years or so. And one of the things with these tax abated deals, because of the way they cash flow, they can essentially drop to about 70 to 75% occupancy and still pay their debt, which is very rare. You can't do that in normal multifamily space. And it's all because of what Bruce just explained, because they created a moat, and they created this, when you drop from a 50% expense ratio down to a 30, and it's just math, your NOI just skyrockets, right? And you create this margin, again, the margin of safety that we were all talking about. And that's why we like this company so much. So again, that's just to reiterate what Bruce said there.
Yeah, and I would say it's one of those that
let me just say this real quick.
Understand.
Sorry, go ahead, Mike.
I was just going to say, it's the type of thing where that's where really digging in makes a lot of difference. Because, for example, I didn't understand why they were selling off the land, and I saw that as a huge negative, and something that I often see other operators do, just to sort of play with the numbers on the debt ratios and stuff, and just sort of make a deal work that wouldn't otherwise. Versus once you got down into it and heard the structure, found out how they can, get it back and that kind of thing. It's almost like it's too good to be true. And so those are the kind of things where it's like, if something's interesting, but, dig into it. There's a lot of things like that at first glance, I'm like, man, I don't like that. Everything sounds good, but this isn't. But you need somebody that'll really sit down and explain it to you so you can fully understand why they do that and what the advantages are. Because I was sort of like, yeah, that's not for me, until I heard, the whole ability to sell it back with the land and get the land back when you need to, when you needed to. So it's just a strategy. I love that.
Well, and they've also got 10-year fixed rate debt, right? And how many sponsors are blowing up right now because they didn't do just that, get good long-term fixed rate debt. I've got an operator in Cincinnati that I invest with. I mean, they're vertically integrated, very similar, and they stick to that market. That's where they're born and raised, and that's where they operate those assets. And that's all they do is Class B industrial with fixed rate debt. So I feel I can sleep very well at night knowing that we have 10-year debt and it's fixed with a great operator that's vertically integrated.
Yeah, that's a great point, Bruce. And we, just add that to our due diligence list. I always look at the debt. If there's bridge debt on a deal, there better be a damn good reason there's bridge debt there. It actually should be used as bridge debt and not for what people have been using it for the last 2 or 3 years in the multifamily space, where they're using it just to force deals to work, to make them pencil. And now they're not penciling. And so hopefully there'll be a lot for us to buy.
Yeah, and one important part on the debt is, especially, that's another, killer for me when I start seeing like a lot of financial engineering just to make the deal work, is really a red flag that, keeps me away. So Hans, what are you looking at, in terms of debt? Like nowadays, they have to be a little more creative. So is there anything that you have seen lately that still makes sense, or?
In terms of debt, did you say?
Yeah, when you look at the debt.
Oh yeah, I mean, in the multifamily space, for instance, this group that we're talking about, they use fixed rate agency debt, agency being Fannie Mae and Freddie Mac, 30-year AM. Many times they'll get full term IO, or they'll get 5 year, 6 years IO on a 10-year balloon term kind of situation. That's standard multifamily debt is what you can accomplish. And that is the go-to right now in the multifamily space is fixed rate agency debt. And I very rarely will want to invest in any kind of multifamily deal that doesn't have fixed rate agency debt right now. Again, unless there's a very good reason and I trust the operator, because there's a value add. Sometimes when you buy a deal and there's true value add and you have to create that margin of safety, you can't get agency debt because they won't lend on a property that's say 80% occupied. They only lend on, there's a 90-90 rule, meaning 90 days, 90% occupied is kind of a rule of thumb, but they'll only lend on stabilized assets. You can buy a stabilized asset and still get upside and value add, but you can't necessarily get agency debt on something that's very distressed. So debt is, it's harder to get now, and the margins are more narrow, but people are getting lower loan to values. I've invested in some deals that are 55% loan to value right now, and they still cash flow like 4% year one, which is great because there is a value add, because they can force rents. So it's a very low leverage, yet has even cash flow year one, which is pretty impressive.
Yeah, and I think it's also, not everybody can be, sponsored by Fannie and Freddie and have access to them. So sometimes it's an extra due diligence that, these large allocators have done. And so if the company you're looking at is able to be either a special preferred client of Fannie and Freddie or have access to that debt, it's a positive.
Yeah, and in the multifamily space, if you can't get Fannie and Freddie debt, then I probably don't want to invest with you if you're not capable of getting it. Now, there are plenty of deals where banks make more sense, right? Bank debt makes more sense for certain deals if they're smaller or they need more flexibility. I'm not saying they're bad. It's a deal by deal thing. And the debt is still out there. It's available for the right deals. But for the really low cap rate deals, you can't go buy a deal that's at a 4 cap and get a 5.5% debt on it. That just math doesn't work. That's reverse leverage, basically.
Thank you. And so can we talk a little bit about, what you're looking at, obviously the jockey and the main guy and operator or partners and their team as well. So, right, I know, Bruce, myself, we like to, interview and spend a decent amount of time with the team itself, from operations to, finances and marketing and communication and whatnot. Do you guys want to talk a little bit about that?
Sure. Well, I've got a pretty deep level of experience in manufactured housing communities. I was in the manufactured housing business for over 20 years. And so, that's an asset class that I am generally looking at because I like the recession resistance of it. But I also have more knowledge on operations, right? I've owned and operated my own. I've done infill in the thousands to help, over 100 mobile home parks in the greater Cincinnati area where I used to be based at, where I used to live. And so, I think a lot of times we have to stick with what we know. Hans probably knows multifamily extremely well. I know mobile home parks extremely well, so I can get really deep in the weeds and, get on a Zoom call and talk with, the people that are going to be handling the operations, because that's not an asset class that's easy to get third-party management on. It really almost does not exist or exist very well. And so anytime you invest in a mobile home park, generally speaking, it's going to be managed vertically. It's going to be a vertical integrated type management team. And so I can, really get in the weeds on the operations side of it and get a level of comfort with an operator.
And that's a very important point, right? Because the due diligence is going to be different depending on the asset class. If you're looking at self-storage, it's different question that you ask than if you look at mobile home park. It's a different question if you're looking at an oil and gas deal. It's a different question if you look at multifamily. So again, use your network, use people who have done that, who have been in the space to try to help you ask the right question to the operator. I wanted to bounce onto, just to give people who are on the call, just some figures on what should they expect on acquisition fees, what should they expect in splits, what should they expect? Can we just go through some of those variables? Maybe Mike, you want to kick us off with?
Yeah, as far as with the whole, just to step back to the last topic with the operator, one thing that I really like to look, I don't always invest in, but I would say half the time I'm investing in a fund. And that's when it's really important to be comfortable with the operator, because when these, the performance get put together, it's all just made up. It's just a guess. They don't know what it's going to be in 5 years. They don't know exactly how it's going to be. And so they can kind of put anything down, and they're always going to be off, up or down. And you hope with a really good operator, you're going to have more times out of, say, like 10 that they are in your favor. And that's what you'll typically see with a good operator that way. But I invest probably half my money in syndications, but I'm a lot more, I really have to dig into those a lot more because you've always have that single asset risk versus in a fund, you dissipate that. So I'll either invest less or not. But yeah, as far as the, I just want to make sure that things make sense. The last thing I'm looking for is where the person is getting most of their fees up front. And it's one of those where they win on day one. They win when the deal closes. I want them to win when this thing is operating and it's being sold and it sells. So I understand a lot of these people have to have, you know, they've got staff and they have to kind of keep the lights on. So you need to have something in there for it. But it's the overall look of it to where does it seem reasonable? And there's some of these guys where the fees up front, it's like it just doesn't feel like they're aligned that way. They're sort of like off the gate. They're getting a lot of money. And the other thing, proportionally, it doesn't take that much more work to underwrite a $400 million apartment deal than it does a $10 million apartment deal. And so to some extent, it's going to be based on that. I don't think that somebody should be getting $2.5 million, you know, on day one in their fees for the acquisition necessarily, when that's just their normal course of business on things. So it's just kind of a balance of those things. And again, I don't have any hard rules, but I know it's kind of, you just look at the overall, does it feel right?
Hans, you want to just give us like
Yeah,
just one amount
sure.
of like,
Yeah. So when I look at fees, number one, like what Mike's saying, you have to be aligned. So on the fee side, you know, on acquisition fees, 1% to 2% of the purchase price. But like what Mike's mentioning, I think it needs to be capped. It, like he said, it's the same amount of work to buy a $40 million deal. It typically is a $20 million deal. You know, I looked at a deal a while back and it was like a $68 million deal, and they were taking like a 2% acquisition fee on the entire capital stack. So not, you know, on top of the rehab, you know, not just the purchase price. So they were making like 1.3 million day one. And I immediately like, I'm done. I don't care how good the deal is. I'm not investing with somebody who's making that kind of money on one deal. So I look at the acquisition fees, 1% to 2%, but hopefully capped if the deal is really large. Loan signing fees, I typically see 1%. I only like to see it on recourse debt, but a lot of operators put it on debt period. I don't think you should charge a loan fee on a non-recourse debt because you're just not taking as much risk. Disposition fees, typically 1%. Construction management fees are 5 to 10. These are high level stuff. And then on the comp models, I guess my biggest point, like there's a million comp models out there and we don't have time to get into them, but what I prefer to see is some sort of preferred return first. In other words, I want to make, say, 8% in cash flow before the sponsor starts taking a cut. So I typically do not invest in deals that don't have some form or fashion of a pref or preferred return, not preferred equity. That's different. People get those confused. Preferred equity is different. It's like mezzanine debt or it's that. But preferred return, meaning I make 8% and then above an 8%, the sponsor makes 25%, I make 75% as the LP or something like that. I always want to see a pref because that gives them incentive to get to a certain point before, you know, that I'd make a minimal return at least before they get paid.
yeah, and I would add to that, like in terms of skin in the game, I know Hans, you're also very careful that, you know, they have skin in the game. Skin in the game comes in different format, right? Like one is recourse debt, obviously is one that you prefer because, you know, when things go wrong, the guy, you know, we've seen operators just walk out of the deal and give it to the bank. And so, you know, in order to avoid that, you know, recourse debt is going to put a lot more pressure on the operator. I think, you know, the second one is how much money are they investing themselves in the deal? And same thing, just be careful about that. You know, some people say, oh, I'm bringing the land or I'm bringing, you know, something into the deal that is not cash. It's just like, but then at the end of the day, when you ask for the real contracts, you actually sold the, you know, the land or whatnot to the syndication at a much higher price, right? So at the end of the day, he's getting out at $2 million for land that he is $1 million, and he tells you, oh, I have $1 million skin in the game, right? Well, no, he just took out $1 million. So, you know, all these little nuances that you wanna, you know, just be careful and watch. I know we're gonna run out on time very fast. I want to open it to questions first, and then let you guys finish on some more due diligence that you guys do. Any questions out there, please?
I guess everyone knows how to invest now.
Is there also any asset class that maybe you guys are more interested in than not? We can go a little, deeper into some questions for the specific asset class.
I'll kick that off. I like to focus on recession-resistant asset classes that I feel have a moat around them. And I'm like a broken record on mobile home parks, but they're an ugly asset class, except they're not ugly financially. They're wonderful financially, right? They're very recession-resistant. It's a scarcity asset class. They're really not building them anymore. The number of mobile home parks in America, the supply is actually shrinking every year because the properties are generally sold for a better and higher use, like a shopping mall or car dealership or whatever it might be. So that's one of them. I like Class B industrial for the similar reasons. Even though they're just metal and concrete, Class B industrial, and they're also offices in Class B industrial, but they're very centrally located in very expensive areas of big metros, and they're considered that last mile delivery area. And so it's very important for the people that rent those spaces to stay in those locations. And so they could find something cheaper, but they'd have to go outside of town, which would totally mess up their businesses. And so Class B industrial is another one. And then, of course, we discussed workforce housing. You can't really build workforce housing today because the cost of construction is so much higher than buying, an asset that was built in the 70s, 80s, or 90s. And so it's built in, it's built to be able to offer a less expensive rent to those workforce housing tenants. So those are some of the asset classes that I've been gravitating towards. I am considering RV parks, though I've never invested in one yet, but it is on my watch list right now.
And I'll agree with Bruce. My top two are mobile home parks and industrial. Not necessarily specifically Class B, because I'm in a variety of industrial, including Class B and also Class A spec build from an institutional kind of company. But one thing that people may not realize is, as you know, e-commerce has been increasing. During COVID, it just shot right up, right? But now it's gone, but it's going up normally again. So the amount of e-commerce isn't just increasing every year, right? And I believe the stat is either 1.5 or 2 to 1 in terms of square footage needed for e-commerce versus brick and mortar retail. So the more e-commerce you have, the more industrial you need. And right now, industrial nationally, I think is some insane number, like 96 or 97% occupied in general, industrial assets are. So there's still not enough right now. And with e-commerce increasing, the square footage is just going up. So I love industrial. I try to invest in it as much as I can. And pretty much agree with everything Bruce said. So I don't have any new asset. Self-storage is great. You got to be very careful in self-storage. Cap rates have compressed a lot, and it's very supply. Supply can really affect individual assets. So you got to be very careful about what you do and where you buy, but it's also a great recession-resistant asset if you're with the right operator in the right market.
I would agree with both of you guys. Mobile home parks is my favorite asset class. And when I'm buying in with an operator with mobile home parks, what I really look for is the infinity play, which means they're buying good assets. And then somewhere between year 3, 5, 6, they're going to cash out refinance. I'm going to probably get the majority or all of my money back. And then we're just going to keep owning it. And I'm going to get, 6, 8, 9% cash flows even after I've got my money back. And then, year 7, year 10, somewhere in there, they can just keep doing cash out refinances on these things. But I want to own those for the long haul. Once you move beyond the mobile home parks, which is the only thing that I'm trying to accumulate kind of more for the lifetime, then I'm pretty agnostic on, what I make money on. There's a lot of ways to do it, but I'm in entitlement and development and multifamily and self-storage and all those types of things. But mobile home parks is what I'm trying to really accumulate for the long haul.
Yeah, and just to bounce on what Hans was also talking about in terms of industrial, obviously it fits my macro view around like the, infrastructure spending that the government is going to make over the next 10 years, which, goes up to like, $2 trillion in that space. And, the re-onshoring and other macro views that I shared this morning. I will share the slides with the group, obviously, after this seminar. Chris, I think you had a question. You want to just unplug your mic and go ahead?
Sure, I lowered it, but I'll ask it anyway. Just I have concerns in the commercial, office building space. That with the trends toward people moving away from large cities. Do you guys have the same concerns? And do you vision any ways to potentially profit off that? Maybe not so much by shorting it, but maybe by conversions of office space into multifamily. Have any of you given that thought or have the same concerns that I have?
I'll just say that I feel it's a speculative play, and I don't like to deal in speculative plays. I want to stick with something that has a positive expectancy, and I don't know where that asset class is going. But I will say that based on some things that I'm hearing as of late, I think office may make a comeback because I think the hybrid work thing is going to potentially implode. And the reason I think so is because the productivity went down substantially from people that are now working from home. And I'll even expound on that a little bit. My daughter is a registered nurse. She now works from home. She audits physicians' notes and things like that. And her coworkers are buying things like vibrating mouses so that the mouse simulates that they're working on their computer while they are taking a nap. Now, if that's going on just in our little circle, and my daughter's not doing that, by the way, she's a good girl. But if that's going on in our circles, it's going on, in the millions in America right now. And I think it's a matter of time. Either we bring people back into the office where we can supervise them, or we're just going to start sending everything overseas for a third of the wage.
And I'm part of another mastermind where I see a lot of actually success in co-working. So transforming these offices in like co-working spaces where, you rent for cheap. You're in like, kind of like close to wealthy towns where people are working from home, but they still try to escape from the home or have at least an office to do a couple of things.
We lost you, Hisham.
Well, I'll agree with what you guys are saying, what Bruce is saying. I think it's a little bit overblown. There's definitely some distress in certain markets. You don't want to be owning an office building in downtown San Francisco right now, but co-working is I think here to stay. I'm doing it myself right now, and I invested in a co-working and doubled my money in that, and I'm invested in another one right now that I think has a great way to expand, and it's just repurposing office buildings in a different way to create more revenue and NOI for the landlord and for the co-working operator. So I think office is not going away. There's a certain amount of culture you cannot build. In fact, there's no culture you can build on Zoom, right? It has to be in person. And until we're not human, I don't see office going away anytime soon. Maybe reduce some. I don't disagree with that, but not Armageddon like some people were predicting, in my opinion.
I'll take the opposite side of that, Chris. I think that office is in for a lot of pain over the next 5 to 8 years. I think it's a very slowly unfolding thing. I'm a commercial broker as a side gig, and these office contracts usually they're at least a 10-year. Sometimes you'll have a 5, and so there's a lot of these companies are choosing not to renew. Now, one thing that's been surprising to me is that the best offices, the Class A, the places where everybody wants it to be, there's a ton of demand in those. So that's the only place in office that there is a lot of demand. But there are millions and millions of square feet across the country of just normal, boring, middle of the road office space, and then your lower stuff that's just it's unneeded. And I think people haven't admitted it yet. And I think that I would be very careful about jumping in now. I think that Bruce and Hans are right. It's not going away. There's going to be some, but we have a way oversupply. There's going to be a huge change in what you can get in loans for it. And I think there's going to be a lot of distress, and it's very slowly unfolding. So I think we're too soon. Some of it will be repurposed, especially in your downtown markets, but these are very tough buildings. You know, it's mostly the plumbing. They just were not designed for the type of you know, that you need for, you know, the plumbing and stuff like that, that you need for, you know, multifamily conversion or something like that. So it's possible. And so your best locations that don't need office and do need it, as long as the municipality will allow it, because usually the zoning's a little bit different, you know, as far as where it's at. So it's all going to happen, and there's going to be money to be made. But I think I'm not looking at it now. And I think we're 3 to 8 years away from where the time to invest in that type of thing is, in my opinion.
Unless they trade like 30 cents on the dollar, like in San Francisco right now. But well, we're coming up to the top of the hour. I so appreciate you guys coming up. Hans, Mike, Bruce, thank you so much for all the wisdom. That's why communities work and support system, because there's always someone who knows more than you do, and tap into that knowledge and those nuggets. So thank you guys again for coming in. We're going to start the next session, which is going to be super interesting as well, with 2 amazing guys on small businesses and franchising. So thank you guys.
Thank you.
All right, so on to the next session and final of the day. I hope you guys are getting good insights into passive investing, active investing, tapping into your network, and really putting the effort into due diligence for all the deals that you're going to get into. I think it's really key for you to make build long-term wealth and time and financial freedom. So let me come in and introduce our next speakers. We have Jay Borgana, who's joining us. I don't know, because he travels so much, but he right now lives on a beautiful island called Hawaii, and he is a serial entrepreneur. He has built multi-million businesses. He has traveled the world. He's a fellow Rockin' Moroccan like me, and he is actually, you know, buying a $17 million business, and he can take us through that, because that would be a good due diligence case as well, and what he's looking at, and how you get into that, either as an active or passive investor into small businesses. On the other side, I have Ryan Rayo, who is a very dear friend of mine as well. He has years and years of experience in franchising. He's a development expert. He has helped many franchises scale. And what I love about franchising is that, you know, it could be a very good first foray for someone who was a W-2 for many years and trying to get into small businesses. A franchise gives you a little bit of the structure and the process, because they have built that process. That's what have been successful, and that's why they launched a franchise, because they have those processes for you. And if you follow them, you know, close enough, you should be fine. And Ryan is going to try to give us a little bit of insight into how he helped people scale, what he's looking at, and also talk to us about the med spa franchise that he's running at the moment, called Vayo. So without interruption, I'll give the mic. Maybe we'll start with Jay. Give us a little bit of your background, what you're working on, and we'll do the same thing with Ryan, and then we'll kick into more details.
Yeah, thank you for having me, Shem. My name is Jay Borgana. I'm actually calling from Honolulu. I've been here the last few years, kind of semi-retired, if you will, just purely investing. I started my career in banking, finance, went into manufacturing, spent about 5 years in China running thousands of workers in a factory of 1 million square feet facility. Then went into consulting for a few years until I got tired of that, built a company, over 4 years, sold it to a large regional strategic and exited twice. I sold part of it in 2018, and then I sold the rest in 2021, and been kind of living the retired life in Hawaii since. I am getting back in the game again. I love businesses. I love developing people, and I love helping businesses grow. So I'm buying a business right now that's in the printing signage industry. It's a $15 million revenue business that does about $4.6 million in EBITDA. And we're buying it for about 17 million. It's been around for about 30 some years. The sellers are retiring. They're going to Florida. This is it for them. And they're very supportive. They want to take care of their employees. They want to take care of their customers. They want the legacy to keep going. And they would love to see the business grow the way they imagined it grow. So this would be a great, and it's an example for investors that want to go passive, because it's an opportunity for different types of investing than real estate. It has, obviously a little bit more risk, but that can be remediated with a good operator as well as a good asset. And it has a much higher return profile than your regular syndication, especially now that we have a high inflation that eats up at those returns. You need as high of a yield as possible. And I don't know if I'm going the right path, Hisham. So you tell me what questions to answer.
That's great. And we're going to go into all this, like, what are we looking at in terms of numbers of EBITDA, cash. But, as Jay was saying, the beauty of small businesses is that they really help you back to cash flow really fast, right? Like in real estate, when you're looking at maybe a cash on cash of like 8 to 10% a year, and then, an IRR 15 to 20, if you buy a small business, because of the leverage you can get through SBA loans, and we'll talk about that as well, you can literally put a small amount of capital down and then cash flow and get that money back the year one, if not, shorter than that. And so that's a little bit the beauty, and that's why I wanted to bring this last session on this. It's not as passive, obviously, as a syndication, but it has obviously a lot more reward and financial reward to it for building wealth. So let's turn to Ryan. He's going to give us a little bit of his background, and also, franchising versus small businesses, and why that's an interesting proposition as well, and how we help those businesses scale.
Yeah, thanks for having me, Hisham. So as you mentioned, my background's been franchising since I've been out of school. Similar to Jay, I started a consultancy about 6 years ago, where we were working with early stage businesses that wanted to franchise, and we would help determine, is franchising for them? And then if we decided to work with one another, we would build out the franchise side of the business. So we had a SWOT analysis, feasibility study. We took in consideration the market, unit level economics, to help model out if this proof of concept has the ability to become a franchise. We had some success as a consultant, but wanted to pivot to a place where we had more of an active leadership control, had a seat at the table, and really drove the growth of the company internally rather than externally, as well as held some ownership. So we started looking for some categories that we believed had a lot of potential. We came across medical aesthetics and partnered with an independent med spa, one location brand in the Cleveland market back in early 2018, with the plans to franchise it. We then spent the next year and a half refining the business, being very thoughtful about the service mix. We installed a membership program, put together the compliance side of the business, and launched the franchise in 2019. We created a lot of momentum throughout 2019, just interest in the category, interest in what we're building from a franchising perspective. And we thought 2020 was going to be a breakthrough year, and little did we know it was around the corner with COVID. But fortunately, we were able to overcome the challenge of COVID, and by the end of 2020, we were able to have 9 locations open in the system, started to see some incredible success stories in those open locations. So in the past roughly 2-3 years since the pandemic, we've been able to open over 20 more. By the end of this year, we'll be the largest full service med spa in the United States, with around 50 locations open. We brought on a minority private equity partner July 1st of last year. So went through a lot of experience, first private equity investment into a company that I've been a part of. So that brought us a lot of experience, but overall very well versed throughout the med spa community, but more so franchising. Prior to going all in with the med spa, we've consulted for many businesses, from mobile dog training to 30,000 square foot American Ninja Warrior parks and everything in between. So franchising is a fantastic path to entrepreneurship. There's also the opportunity to acquire existing franchises rather than continuing to build and start new ones. And certainly happy to be a part of the session today.
Yeah, and funny you say that, because Jay is actually buying a franchise, signed franchise.
There you go. Yeah.
Now we're going full loop. So Jay, you want to tell us a little bit, like, what are you looking at into? Maybe let's back up a little bit. And if someone wants to start, this journey, the first thing is to start understanding where to look for and how to build a funnel. And I think Jay is really is a great mentor for building your funnels, connecting with brokers and whatnot. So tell us a little bit about that, Jay.
Yeah, so it all depends on the person, obviously. This journey for acquisition entrepreneurship can work for an employee that wants to quit a W-2 and wants to acquire a business. So for that person, there's two types of personalities. There's a personality that likes to manage people, and there's a personality that doesn't like to manage people. If you like to manage people, then you can go and buy a business that has lots of people to manage, in a service business. Or if you don't like to manage people, then you probably want to get some consultancy business, some type of agency business that's going to be, have little labor or little number of people as possible. Then if you're an entrepreneur and you want to grow, business acquisition is a great place to get from being self-employed to owning a business, to building buying a platform. If you're a business owner and you want to scale and you'll be able to exit, in 5 years, acquisition is a great place to acquire new talent and a big list of clients. If you're an investor, acquisition is a great place to get higher yield and diversification from real estate. So every type of acquirer has a different goal or a different why behind doing acquisition, and they're gonna take a different path in terms of like how to do that. In any case, you're gonna go through two ways. Either you're gonna go through stuff that's on the market or with brokers, or things are off market where you go direct to the sellers. Probably about 60% of transactions that happen through brokers. So I would start there first. I would try to figure out, the local association of business brokers. I'll look at the list of IBBA and M&A associations, and then just connect with them, call them, tell them your story, tell them that you're an entrepreneur that already owns a business and looking for a bigger platform, or you're an employee that has a lot of experience in a certain field and you're looking for a business within that field to run your own business. So you got to craft that story that's going to make it appealing for them to work for you, and trust that you are not someone who's just a tire kicker. You're an actual real buyer. And it does help to go out and get kind of pre-approved, just like you would do if you're buying a house with an SBA lender, and get your financials and get maybe a document that says that we're ready to finance you. So that gives you a little bit more gravitas with the broker, and essentially it's just a numbers game. You got to talk to as many brokers as possible. You have to follow up with them. You have to build as much rapport as you can, tell your story over and over, and eventually look at deals. So eventually they will send you deals, and usually it starts with some basic information. You sign an NDA. and then they give you the financials, probably 3 years worth of financials. I like to recommend people to have an investing committee, and maybe 3 or 4 people that they trust, that they know that they can run these with, and they can think to ask questions and think through the process. And it's not a bad idea to have that group of people that you can trust, that you trust their opinion. And usually the process, you analyze data, you form an idea what the offer is going to look like. It might have a combination of cash, debt, and maybe some seller financing, maybe some seller earnout. So there are different varieties of structures that can be put in front of a seller. I always recommend, before doing any of that, to talk to the seller once via Zoom, and then ideally meet with them in person and spend some good quality time to understand them, understand their business, understand who they are, because the quality of the owner is going to tell you a lot about the quality of the team. And if you like the owner, you're going to like their team. If you like the owner, you're going to like their customers. If you like the owner, you're going to like their vendors. And so if you like the owner, you're going to like the business. So the more you spend time with the owner, the more you're going to understand who they are, what they're about. You're going to understand more about the business. And then you're going to be able to formulate a good offer that's going to work for them. It's something that you do side by side. It's not like it's not a confrontational exercise. You're trying to find a win-win for everybody, and something that the bank will finance, obviously. So the goal is to minimize the amount of cash you bring in, maximize the amount of seller financing, seller earnout if possible, and the rest. Yeah, then you go through the exercise of due diligence and so forth. I don't know if you want me to go there.
No, I was going to actually ask Ryan to tell us a little bit, because that's what I was saying with franchising. At least you have your franchisor and you're paying a fee for that. They're going to help you through all the process from A to Z. They kind of can handhold you a little bit and get you through the motion. So Ryan, maybe you want to take us through, the first step into, discovering the franchise, doing a discovery day, then maybe going to putting an LOI out there, and they can help you with that LOI and the writing of that LOI. Then you got to find like the space, for your franchise. And it's always good to work with franchisors, because on your own, if you want to go and rent a space in a strip mall, for example, they're obviously going to ask for personal guarantee, but they prefer, bigger operators who have maybe the mothership guarantee, and they give them a little more comfort that they're going to be able to stay here for 10 years and pay their rent and all that stuff. So, but if you have a good franchisor behind you, they also have a relationship with some of the big dogs out there. And so, Ryan, if you want to take us through some of that stuff.
Yeah, definitely. So similar to Jay, there's kind of this journey he spoke about as far as tracking down your first franchise opportunity. And there's 2 ways to go about it, and I'd recommend doing both. There's franchise brokers. So there's brokers that work just in the franchise community, where they would work you through a questionnaire, potentially a personality profile of helping understand, based upon how much you're trying to invest, what your goals are for involvement level, industries you're interested in operating in, how many employees you want to work with, or passive ownership, etc. They can filter down some opportunities for you. So it's kind of pre-screen, go from the 3,000 to 5,000 franchisors out there down to 10 for you, to give you a look at some different opportunities. The other way to go about it is connecting directly with franchisors. So not every franchise is in broker networks, and there's reasons they're not in broker networks. They may not need to be in broker networks. Crumble Cookie or Orange Theory Fitness, some of these brands that grew extraordinary fast in the last 5 to 10 years, they weren't in broker networks because they don't need to be. People see them, word spreads, and there's this organic interest in getting involved in the brand. So, my only flag I'll pull for broker networks is they're not showing you every option out there, because not every option is in their inventory, but it's a good place to start to see what options could be. I just wouldn't exclusively rely on them. once you dive into speaking with the brand, they have a process. So they're going to want to get to know you. They're going to provide insights about how they support you, unit level economics. They bring you in for discovery day, so you'd have a chance to come in, meet the leadership team, go through a presentation, tour some physical retail locations or mobile operations, however they're set up. And then following discovery day, you really should have a comfort level on, is this an investment I want to make, as well as the brand? Is this a candidate I want to bring on? What probably the most important step in the buying journey of your first franchise is speaking to as many franchisees in that system you can. So you want to connect with anyone you can, underperformers, high performers, learn about the relationship with the franchisor, would they make the investment again, challenges, all the questions that you'd like to have answered. That's where you get the true understanding of unit level economics, true understanding of franchise support, culture in the system, etc. You'll hear about it from the franchisees. What's also great about getting involved in a franchise, especially if it's brick and mortar, there's a clear path to growth. So whether you have additional white space, so you've acquired more territory, or if there's other locations in the system, you can go in and acquire those, and you don't need to change the technology system, change the operating procedures, adopt the culture. Everything should be very similar, nearly identical from the locations you operate. So once you get involved in a system and you're performing well and you want to grow, franchising provides you a clear path to growth. And what's also unique about franchising is, let's say you start to grow and you have 15 locations and you're generating $2 million in EBITDA. That becomes an attractive asset more so than a single location. So single locations in retail, hypothetically, they trade for 3 to 5. You create this platform in a franchise from an exit value standpoint that's doing $2 to $3 million in EBITDA. All of a sudden, they could trade 6 to 8. So overnight, you create an arbitrage of value versus what you can buy a 1, 2, 3 unit owner for, compared to what you would trade as a large operator, as well as white space. So great franchise systems, though you just bought this location for $50,000, they'll pay you $300,000 because you can model out the performance. I have 15 locations generating X, build out cost is Y. I'll pay you an additional $300,000, $400,000, $500,000 just for having that territory because I'm so confident in the potential performance of it. So franchising it's a great path. It's interesting, but just like anything, it's certainly not without its challenges.
Yeah, no, thanks. A lot of gold in there. Even for me, that knows the process, everything is you got us a lot of information and interesting stuff. And just to go back to that multiple, just for people who are not familiar with, that's how you value a little bit like businesses. So you would take either EBITDA or what they call SDE, which is the owners add-ons to some of the net profits. And then usually small businesses, and that's the beauty of small businesses, that you can buy something for just 2 to 4 times that multiple, which, as I said, if you're leveraged, you probably get your money back, pretty fast. And what Ryan was explaining is that once you're in a system with, if you're on your own, you're probably going to sell for 3 or 4 times. But if you're part of a group that is going to sell maybe at some point together to a private equity, your multiple gets to 8 times that EBITDA number. And so you create a lot of wealth very fast by being in that ecosystem or having multiple location on your own. So we'll go back to Jay. So Jay, what did you find so interesting and intriguing for your franchise, and how did you make that choice and decision?
Yeah, so the franchise that I liked was the main thing that I liked about it is the fact that even though they have territory restrictions, they don't really have sales restrictions. So you can even though you may not be able to open new facilities within other people's territories, you can also sell if you have a large clients anywhere else. So that's why one location that usually on average would do about $1.5 million in revenue. This one location is doing about 15 million, and it did, even 16 at some time. So I like that a lot. One of the caveat to that is that there's part of what makes it like the negative piece of it is that the franchise limits the buyers of the franchise to owner operators. And so that kind of makes it where that private equity, sale, if you do a roll up down the line, can be a little bit more challenging. So you need to find a structure, and you need to sell that structure to the franchisor first before you can go out and pursue a buyer. So it kind of creates a little bit of a friction at the exit, if you will. And so it's an interesting, definitely the opportunity set is the fact that it's definitely you have support of the franchisor. If the seller is no longer involved, you still have the franchisor to support you in terms of the business itself. The business has been around for 30 years. The franchise has been around for 50 years. There are 700 other entrepreneurs in there. So there's a good network. There's a good mastermind. It's a good brand. It's well known, and it does have a lot of opportunity to grow. So to me, that's kind of like the main thing is the fact that this couple that owned this franchise for 30 years really started out not really knowing what they're doing, but then developed a really good business. And I can only imagine if you come in with more experience, with more knowledge, what you can do with that.
Thank you. So I want to, there's one thing that sometimes is a counterintuitive, but it's size. And so surprisingly, first of all, a small business is a lot less risky than, putting money in a startup business that you find, because it's the opposite stats, right? Like 95% of the startups are probably going to be zero, and you may have a unicorn. And therefore, if you're not a private equity who can invest in 100 of them and hope for that unicorn to be in there, your chances are pretty low. In small businesses, it's the opposite. It's 95% of all small businesses actually survive and continue to project the same P&Ls. And so it's a lot more stable. The other counterintuitive thing on small businesses is size. So people are, especially when they start, they're a little afraid of the numbers. They're like, well, I'm just going to start with like someone who makes, an EBITDA of maybe 200 to 400 grand and see how it goes. But it's counterintuitive because it's actually easier to buy a business that has an EBITDA that is higher than 500K and is going to cost you, I don't know, call it $1.5 to $5 million or more than buying a business that is less than $1 million. And there's only actually 4% of the businesses that make more than $1 million in revenue. It's crazy, but small businesses, they're really small businesses. And so, once you get to that size, why is it less risky? Because the smaller one, you rely a lot on the owner, right? Like it might be like, I don't know, a landscaping business. Well, it's all it's about the operator. It's the main character in there that knows a lot of these clients and stuff. And once he leaves with the clients, or a lot of clients leave. So it's a lot more risky. Whereas a business that is bigger and more than $1 million is also, has processes in place, right? Because they're growing from, $1 to $5 million. They need to grow. So they need new systems. They need an HR department. They need a CFO. And so all those processes are there to help you. And same thing with what I was saying with franchises, they have the processes for you. And so that's also a little less risky. And the corollary to that, it's in franchising as well. So maybe Ryan can talk about that as well, is the franchise. If you buy a small franchise that, probably generates less than $500,000, well, same thing. A lot of the franchisees are going to be small owners, operators with not a lot of experience. in, for example, the med spa business that Ryan runs, well, the investment is higher. It's $1 million, right? So already you kind of filter to a higher caliber of franchisees who come in, and then your network, because that's what we're doing here, right? We're talking about mindset, we're talking about being in a community. That's what helps you also avoid the mistakes and grow and scale. Well, in having those franchisees that have the ability, because they already were successful, they are able to put $1 million in, that also matters, right? So size is a very counterintuitive thing in small and businesses. So I want to give a chance to Ryan and Jade to react to this.
Yeah, I agree. So I'll say if I'm looking at a franchise and kind of size of investments, there's attraction based upon what you're trying to accomplish. So Hisham talked about IRR and payback periods and different things like that. So there's franchise brands that are $50,000 to $100,000 overall investment. Some of them are mobile, like let's say mobile dog training. Hypothetically, you could purchase a mobile dog training franchise, be an owner operator, so you're really passionate about dogs. You invest $50,000 in a year, you're making $100,000 to $150,000. That payback period is spectacular. I got 100% plus return investment in a year. I'm making more than my initial investment every year. However, do you want to be a mobile dog trainer? You may want to, you may not want to. So are you looking for a job in addition to an investment, or are you looking for an investment where you can put a team into place, understand the business, the key performance indicators, provide leadership to the team, and do something more passively? I generally find the more passive investments are a little bit higher ticket, just to be able to afford the ability to put a team into place. So, let's say an average unit volume of $1.5, $2 million in that kind of business, franchise or non-franchise, you should be able to afford a director of operations or a manager, a leader for that business who can run it. You can hold them accountable. You can keep, a sense of the KPIs, et cetera, provide leadership in the business, but you don't have to run it. So it depends what the attraction level is, and payback periods will change. It's really challenging to get 100% payback period in a year if you're investing $1 million. If you do, let me know, because I'd be interested in that kind of business. But generally, those kinds of higher ticket, I'd say the sweet spot's 3 to 6 years for a payback, because you're putting a team into place. You're not operating itself on a daily basis. If you're operating it yourself and it's lower ticket, you can create really compelling paybacks, but it's challenging to just put someone into place and have enough of a margin left over to make it meaningful for an owner.
You can get a year payback in the resales if you get a good resale. Because you're going into existing revenue, you're going in existing earnings, and you have a team in place. So that's the difference. It's a higher investment. You have, obviously, you're taking on leverage, but definitely that's where I like the resale piece better than the startup, because you have that cash flow coming in day one, and then you can build on that team that's already existing. And just to go back to the question with Hisham about the size. Big is beautiful, bigger is better. And the reason why is because you have more earnings to pay good people. You can attract and retain better talent. And if you have the ability to, if you have a higher revenues, higher cash flows, you're able to do that. So, for me, when I think of business, I think the job of a CEO is to be in the attraction game, to attract high quality clients, to attract high quality talent, and eventually to attract high quality capital. So if you have a good size business that has higher earnings, that helps a lot in doing those things.
Yeah. And so now, in terms of can you share some of the due diligence that someone should be worried about, or like, the question they need to ask that for you would be red flags that, it's a no-go?
Yeah, well, to begin, just to understand the process of the due diligence. So it's kind of like just like buying a home. So when you buy a home, you're going to do a home inspection, you might do a roof inspection, you might do a foundation inspection, you might do all these things. So there are vendors, there are third parties that can do that for you. And it's the same thing for a business. You do a quality of earnings report, and there's a company that will do that. That's the financial inspection, if you will, that can give you a working capital, a net working capital report. That's also a report that can come with that. You can have if the business has equipment, you can have someone that specializes in inspecting that equipment. You can do an HR kind of analysis and understand who you have and what kind of employment contracts you have. You can have a legal due diligence where you can understand kind of if there's any risk around lawsuits and everything. So all these elements are necessary, and then there are vendors and third parties out there that can do that for you. What I would say for an entrepreneur, they themselves have to, throughout that process, they have to validate their original thesis. When they came into the business, they thought, okay, I love this business because I have some knowledge in the space. There's a potential for growth. The team, the business has a good team and all that stuff. But then that's looking at it from the outside. The due diligence gives you the opportunity to step inside the business and see it from the inside. So you're going to get a lot more information within that 60 to 90-day period that can help you either validate your early perception on the business or not. And then also the seller's behavior. And I mean, the seller is cooperating, is helpful, is continuously communicating. That means that they're going to be doing the same thing after the sale of the business. So you're going to have that support, you're going to have that feedback from them, and you're going to be able to work with them down the line. So I think, like, for me, the due diligence is just, it's part, obviously, checking if what the seller has said is true, and then also validating what my perception on the business was, and if what I'm thinking I'm going to be able to achieve with that business is still possible. And that's what I love about the process of due diligence. You just, you get deep with the business, you get intimate, and you get to know both the owner and the business.
And I just add, from a franchising perspective, it's all very similar if you're buying an existing unit. And the two key traits always in franchising is the management team of the franchisor, getting to know them, understanding their background, their track records, and then other franchisees. Connecting with franchisees, just like this mastermind, that's a huge value in a franchise system. So again, uncovering relationships with the franchisor, trends in the system, things that they've learned, what would they do again, opening their first unit, etc. Those are all very helpful to help understand if the franchise brand is right for you.
Yeah, that's so powerful. It's interesting because when I was looking at this opportunity that I'm looking at right now, I asked around in my network, and I was connected with another franchisor who does large volume. And then I had this really good 2-hour Zoom call with him where he gave me so many insights on the franchisor, the business itself, the industry itself, the challenges, the margins, all that stuff, which was very helpful when and they introduced me to other franchisors, and then I did the same thing. And it was very helpful for me when I went to meet the sellers. I flew out and I spent a full day with them, literally from 9 in the morning until 8 p.m. And we had, and it was very helpful in terms of not only confirming what I had, but also being able to have a deeper conversations with the sellers and position myself as the right person to take over. Because when you buy an existing business, there's this kind of an odd thing where the sellers are selling you their baby. They've put in a lot of sweat, a lot of capital, a lot of years, a lot of their life in that business for 32 some years, and they're they're really checking you out. They're really making sure that you're the right person for that business. It's not just, they're selling you a car or a house, a thing. It's a lot more than that for them. So a lot of the employees that grew up in that business, a lot of those families, they're connected to. So they're connected to their clients. They're connected to their vendors. And they're connected to their mastermind within their franchise. And they don't want to, if they were the person that used to go up on stage and take the award for the number 1 or number 2 franchise, they don't want some schmuck to come next year and just, do that. So they care about who the person that's going to buy the business a lot, probably as much as they care about the price or the terms or the negotiation. So there's an exercise where you have to kind of sell yourself, and you have to position, you have to tell your story, and you have to convince them that you're the right heir for that business. And I don't know if you guys are fans of Succession, but there was a scene when Roy was trying to buy the PGN, which is kind of CBS, and he's talking to the CEO of the company, and he gave her an offer, like an insane offer, something like $35 billion for the company. But he said, the money, aside from the money, do you trust me? He kept asking it, do you trust me? Because unless you trust me, there's no deal. Because whatever terms we agree on, you and I know that I can go around them, and I can give you the money, but it doesn't mean anything if you don't trust me. And then these are kind of like two families that don't really connect, the Fox News and CBS kind of situation. But I do believe it's so true that when you go into a transaction like this, there needs to be a high level of trust.
Yeah, no, absolutely. And it's, as you said, it's their baby, and they care about a lot of the time, the good employee, the one you want to buy the business from, they care about their employee. And, they a lot of the time, be wary of people who didn't want to pay 401ks or participation or help their employees, or don't care about the employees. Say, a lot of the time you may want to offer like a 5% to the number 2 that is going to, help you launch and scale the business, because the owner is going, and that's money well spent. So I wanted to go back just a little bit to, again, franchising, and Ryan, like, you help with a lot of these things, right? Like, you help people find the right HR software. You have your own like CRM. You have all these things that you already pre-built for yourself to help people scale faster in their business. Can you speak a little bit to that?
Yeah, definitely. And I think any franchisor should. So we're an emerging brand. We have 27 locations open today. We'll have around 50 by the end of the year. We're not, as Jay mentioned, I think he had said there's 700 locations in the sign company or company he's considering. So what's unique about an emerging franchise brand is there's a lot of opportunity to grow and capitalize for getting in early, but it's not as established as a 5,000-7,000 unit system, because there's just more proof points out there. It's well vetted out. They have built it for scale, and there's little iterations at that point. An emerging brand, we put together our playbook, but the playbook, at least for us, because we have a continuous improvement mentality, where our next opening is our best opening. We keep tweaking things. So we certainly have our tech stack in place, but we've gone through a POS transition. That was 12 months ago. We now have our point of sale system integrated with electronic medical records as well as CRM, fully vetted out, that we're comfortable with scaling. We went through a design change 24 months ago. So we have our design that we're going with moving forward. We continue to iterate service offerings because it's a fast growing category. But the point is, we have a lot in place. However, when you get into an emerging franchise brand, part of the challenge of it is it's not always going to be the same versus an established franchise brand. But when you don't have an established brand, it's challenging to grow. If you want to acquire, there's opportunities for that, but there's also 500 for other franchisees trying to acquire as well. So it's challenging to grow versus an emerging brand. There's a lot of white space. There's just more changes than a more established brand. And one thing I'll note too, Jay brought it up earlier when he's considering his brand and payback periods. It's important to look, no matter the age of the franchisor, what does it cost me to acquire versus what does it cost me to build? And what's attracted to the med spa category for me personally and why we got into it, if you can execute well, or even at an average level, there's a big delta between what it cost me to build this unit versus what I could sell it for in the form of EBITDA potential and then the multiple associated with EBITDA at exit. There's a lot of brands out there where it's kind of a one-time sale, like the sign industry. I buy a sign. I'm not on a membership program for that sign. I'm not buying a sign every month. It's not a reoccurring type service. So generally, those transactional businesses, there's not a large multiple associated with them because the quality of earnings isn't at the same level, the quality of revenue, as it is for more of a membership, reoccurring, transactional type business like the med spa industry or fitness industry or any retail offering that has memberships in place. So if I'm looking at building a new sign franchise versus acquiring a sign franchise, I want to see what's it cost me to build versus what it costs to acquire. A lot of times you can acquire for cheaper than you can to build, and you take out a lot of the executional risk. So finding a site, hiring a team, developing your brand in the local level, etc., versus just acquiring an existing location. I know, hopefully to a greater probability, what revenue and profitability looks like, as well as there's a team currently in place for me.
Yeah, and just again to come back to the numbers, and because at the end of the day, it's also like in terms, is it a good investment? Because this summit was about financial stuff. So let's be concrete. Like, let's say I have to invest in this like med spa franchise. It's $1 million. I can only come up with like $150,000. And then, hopefully by year 2, I'm starting to cash flow maybe 400 grand. And right away, my value went up from, $1 million, which is was my initial investment, and only a cash out of 150. But once I get to $500,000, which could take, just as soon as, 2 years, we saw one of the franchise, come up in 1 year. So right then and there, you're at 4 times 5, you're already at 2 million valuation for your business. And if you stay with it and you cash flow and you have an exit to PE where it becomes more like 6 to 8, then you created wealth to 8 times that, and double that in the $4 million business, right? So there's definitely interesting value in small businesses. And same thing, Jay, you want to share a little bit, like even as a passive, if someone wants to be passive, they doesn't want to do anything, and I know you're bringing up an offer because you're going to raise money for your own, for that small business that you're raising. What are you offering investors?
On mute. Okay. Yeah. So we're raising about 4.1 million. The preferred return are 3 times the invested capital. So we're offering 3 times invested capital within 5 years. And then the investors stay in for 10% in the business through the life of the acquisition. So, and just that 10%, from the cash flow that we're offering right now, it's around, 10% cash on cash. So they're getting a 10% cash on cash, 10 to 17% cash on cash with a preferred of 3 times their money, which is about 32% IRR. And they stay on for another, 10% cash on cash afterward.
Wow, that's impressive. So we see, just to put it in context, where we were talking like 6 to 8% usually cash on cash on good, real estate deals, and then maybe a 15 to 20% IRR. In this case, you get, up to 17% cash on cash and, a 30% IRR. Obviously, you have more risk on the operator himself and the operations. But, as like a building, if the operation works, it's a cash flow business that's been proven for 32 years. So in a way, you get that cash flow, and you're backed up by that cash flow from the business. So
yeah, and I mean the on the real estate, whether compared to the real estate, and I invest in a lot of syndications myself, and I invest in real estate myself. There's always that operator risk. No matter what you do, there is an operator risk, whether there's a real asset or a business. I think the business is lower risk because you're going into a business been around for 30 years that already has a team in place that's running the business, and the seller is probably it's probably physically and mentally exited the business 3 years ago. So he's not even part of this business that's still growing. And then the asset risk is, again, you're not going into a multifamily where you have to increase rents and you have to add value to the building in order for you to reach your numbers. Like the business that I'm holding, I'm underwriting it with no additional growth. So as is, with the cash flow that it has, including inflation, we're going to be able to deliver those numbers. So there's different profile of risk, when you're comparing. I make these comparisons because I invest in multifamily, so I understand kind of the game.
Amazing. All right, guys. Well, we've been at it since 10 a.m. this morning, and there's some still kudos to those who stayed for most of the sessions. I'm going to open it to questions, and then maybe we'll get a closing from Jay and Ryan. And you can also put your emails in there if someone wants to open a med spa franchise, or has a friend who wants to, or wants to learn more about it. And Jay, if people want to ask you questions because they're starting a business or they want to buy one and they need your advice or participate to your venture, I think you have a webinar next week as well. So you can reach out to me again, info@wealthflowpartners.com. You can reach out to Real Legal Solution, who has been amazing hosting us today. Thank you, Tammy and Liz, who've done an amazing job in reaching out to all the participants and everything, and organizing everything. So again, big hats off to you guys. And thank you to Ryan and Jay for staying with us and sharing their goods. Any last questions, guys, on small businesses? All right, so Jay and Ryan, I'll either let you close or we can close. And if you want to put your emails in the chat, please feel free to do that.
Yeah, I just put my email in the chat. Thanks for having me, Hisham. Nice meeting you, Jay, and everyone else. And whether it's med spa or anything franchising, don't hesitate to reach out. I know some great brokers that I'd be happy to connect you with, just to learn more about existing and new development franchise opportunities in the market.
Yeah, I just want to close on a note that there's a higher purpose to buying or starting businesses than just making money. There are millions of businesses that transition from older generations to the next generation, but never make it. There are millions of businesses that were they're put out on the market but don't sell, and those businesses end up closing. Jobs end up getting eliminated. Opportunities and compounding of knowledge and experience get destroyed. So I think there's a higher purpose to society, and I do truly believe that there is distribution of talent is very equal, but the distribution of opportunity is not. And if we can find a way to leverage that knowledge that exists within that business to grow that team that's within the business and create opportunity for them, I think there's just a higher purpose and a higher calling than just the money. The money will always come, but doing something to make the world a better place is always a great thing.
Awesome, guys. Well, thank you everybody for spending the day with us in this financial summit. Please send your feedback to me, to Liz, to Tammy, to we want to learn what you like, what you didn't like, and we'll take it from there. And thank you, Ryan and Jay, again for spending time with us.
Thank you.
Thank you. See you. Bye.
Bye.
Thank you for that. That was great. See you later.